All right, welcome everybody to the Fibonacci lesson. This is a very specific tool used to measure retracements in the market. This lesson isn't long. It's not long at all, but it is very important if you want to be precise in your entries, precise with your stop losses, and precise with your take profits. So it's important in that aspect because it's going to help you manage your trades properly so long as you know how to place the Fibonacci tool properly, which is what this lesson is all about. All right. Now, the biggest mistake traders make is that most traders draw Fibonacci from random swing points and wonder why it doesn't work. There's a lot of traders out there that think they understand market structure properly, but they're picking the wrong swing lows and swing highs, or the swing highs and swing lows if you're going short. The Fibonacci retracement tool is not an entry system like you think it is. All right. I say that again. The Fibonacci tool is not a retracement, not an entry system. It is a location tool that helps you identify where price is likely to retrace within an existing trend. You understand what I mean? Like if you place your point A here to point B to your point B here, this is where it's likely to extend. You understand what I mean? Like you don't know where the market or when the market is going to give you the retracement until you have specific indications in price action. But the retracement tool is going to give you a location where price is likely to retrace within an existing trend. Market structure is what tells you direction. The Fibonacci tells you where to enter. It's not an entry tool, but it gives you an area. And what am I always sending in our setups? When I give you an entry level, what appears right after? What word? You guys know what it is.
Area of interest.
Area. I always tell you if we're trading gold, 42.55 is the entry zone and 42.55 area is the entry zone, meaning anywhere between 10 ticks, 5 ticks, 20 ticks in that area of the level that I give you is where you're going to enter at. All right. So market structure is what tells you the direction, but the Fibonacci tells you where to enter in the area. So a structure first, Fibonacci second, every time, all the time. You never place your Fibonacci first, ever, until you've sat there, analyzed market structure, identified for longs, higher highs and higher lows, and identified for shorts, lower highs and lower lows. Once you identify that, then you can use your retracement tool. You never just immediately place your Fibonacci tool unless you've already done the analysis. All right. So step one, like it says right here, identify market structure, just like I was just saying to you guys. So before touching Fibonacci, you have to determine if the market is bullish or bearish. So for bullish structure, you want higher highs and higher lows, which these are the higher highs and higher lows, right? You want to determine that. For bearish structure, you guys already know this from the market structure class. For bearish structure, you want your lower highs and your lower lows. That will determine where the lower high will be. And if you place a Fibonacci tool, there's a high probability that that's where the lower high will form. Probability doesn't mean just because you've placed the proper analysis and you've got a 618 and everything is lining up with different confirmations that I've taught you guys. It doesn't mean that it will happen. It just means that there's a high probability that it will happen. All right. And the most important part, just because you're in front of your computer, you woke up, you're fresh, you've got your coffee made, you've done your analysis and everything, it doesn't mean it's going to happen. And also, if structure is unclear, like if you wake up in the morning ready to trade, but you can't tell if the market is going up or down, what do you think you should do as a trader? This is very important. If you can't
Wait.
tell anything
Stay out
that's
of the
happening,
market.
stay out of the market. If structure is unclear, number one, stay out of the market. And number two, do not use the Fibonacci because it is more than likely that it's not going to work that time. A lot of the times, there's really nothing to trade, and I've done it before. There's nothing to trade, but I slapped the fib on the chart, and the fib made the shit look good. So you trade the shit and you get shit results easily. Happens all the time. I don't do it anymore, but I used to do that back and forth. I'm like, no, man, this looks good. Clapped easily. Because what you don't want to do is depend on the Fibonacci. That's not what you want to do. The only thing that you really truly want to do is depend on your ability to read market structure. That's why I stress that this tool is just a secondary step in your overall analysis. It's not your primary. It's a secondary step in your overall analysis, period. So let me see here. So we're going from when the structure is unclear, you don't use the Fibonacci. Let me pull up this example here. The higher highs and the higher lows. So a bullish example to use the Fibonacci is when there are higher highs and higher lows created. This confirms what? If higher highs and higher lows are created in the market, what do you guys think that have the experience? What do you guys think that's that's telling you who's in control, the buyers or the sellers?
The buyers.
The buyers are in control. Now, when price creates a lower high and a lower low, this confirms who's in control.
Sellers.
The sellers. So you have to confirm all of that. All right. Now, after that, step two is find the impulse move. Meaning, an impulse move is the strong expansion leg that breaks structure. Does anybody know what that looks like? An impulse move in the market.
Yeah, usually that's where I get caught. That's usually that big spike that tells you it's gonna go that direction, and then it has to pull back to actually get liquidity before doing the actual move. So that's
Correct.
something I wanted to ask you to kind of pinpoint for me to see
Mhm.
where my error is coming in.
We'll get into that because I'm going to pull up the chart and we're going to get into all of that. And remember that as far as what you want to go over while you're
Yeah.
when we're on the chart, and so
Mhm.
we can correct that for you. So an
Is
impulse.
that
Say it again.
I was gonna say like where step two is, the green one on step
Yep.
two? Is
Mhm.
that kind of impulse right there? That little spike, that break structure?
Correct.
And usually you buy
This
it there because you think it's going to continue, and that's exactly where it pulls
and that's
back.
where you get caught. Now
Yeah.
remember, what's the thing that's important about the impulse move, besides the fact that it's a strong expansion, it's also breaking structure. A real
Hmm.
true impulse move that you want to see is something that breaks structure. So, like in
Hmm.
this instance right here, this is the impulse move and it broke structure. So, this leg is where you're going to measure the Fibonacci, right? Because you had a higher high, you had a higher low, and then it created a higher high and now creating a higher low, right? So, it
Hmm.
breaks the structure. And what does price do when it breaks structure? What does it tend to do after it breaks structure?
Usually comes back to test it.
It usually comes back to retest structure. At what time? No one knows. Only the market decides when it wants to break structure.
Um,
Impulses are
it's u-
always different sizes. Sometimes they're short, but they do the job. Sometimes they're really long, and you have to wait for the change of character inside of the price action to determine if it's going to start to turn around. And the same thing goes for impulse moves to the downside. You see that this is structure. We had the impulse move to the downside, also confirming that it broke structure. This is what you measure, right? This right here is the impulse move high to low. And then we wait for this retracement to start coming back into the area. And that's how we gain
that's
proper entry. It's really the trick to it is waiting. That's the real trick to it. If
Yeah.
you can't wait, you're always gonna get clapped, or you're always gonna get buys at the highs and sell at the lows. It happens until you have to you have to give it time to shake off all of your bad habits and all of the reactions that the market inflicts on you. That's why it's always best to just wait. Like, hold on, you're not going to get me right there. Because the impulses are made to trigger human behavior. When you see an impulse move, you're like, oh, it's just going to keep going. Not necessarily. Maybe it will, maybe it won't. But what you don't want to do is buy the impulse. That's what you don't want to do. You want to wait for the impulse to complete and wait for the retracement, if there is one, and then find your entry from there. Right?
And then just keep going in whatever trending direction. Then you're just gonna like on the green part, the green chart. Then you're just gonna hit like do a long trade, and
Yeah.
then
In an
bond.
uptrend, you're only going to look for longs. Like if the impulse breaks and confirms a long, an uptrend, then you're
Right.
only going to wait for long positions in the retracement area. Same thing for shorts. You're going to wait for that impulse to finish, and then you're going to wait for shorts in the retracement area. You understand? Like you wait
Yeah.
for it to impulse, let it do its thing, go as high as it wants to or short as it wants to, then wait
Yeah.
for it to start retracing back and come to you. Then you hit
Right.
ride on the train and go either direction, depending on what you see on the charts.
You don't wait for it to change directions again. That's where you just kind of wait for your key levels, and then once it hits a key level, then just hop in. Or do you want it to start going back up like a tick or two just to see that, to know that it's gonna, that it's changed directions?
Well, we're gonna get into that next too. We're gonna get into that next. You're gonna be the proper way to do it, like the advanced way that I do it is I just set limits. And if price gets into my area, my limit is typically activated and it goes.
Okay.
The correct steps to take are you wait for price to get into the area and then start forming, if you're going for longs, start forming bullish confirmation patterns. Then you get in, set your stop loss, and set your take profit. But the way we do it, because I'm so advanced and skilled, we just allow price to come to us. And it ticks us in, and a lot of the times we're in instant profit because I'm so good at reading market structure.
Right.
Everything revolves around how good you read the market structure, straight up. All right. Any questions on these steps 1 and 2? Anybody?
No, I think you'll go over it during the lesson. So
Yeah, I will, because we're just going over the steps and then we're going to start applying the steps. And that's when it's going to start coming together for you guys.
okay.
So step 3 is drawing the Fibonacci correctly. For a bullish market, you're gonna draw the fib from the swing low to the swing high. Meaning, this is the swing low and this is the swing high. Point A goes on swing low, point B goes on the swing high. Make sense, guys? Now, for the shorts, for the bearish market, you're going to draw from the high to the low. You're going to put point A on swing high and point B on swing low. High to low for shorts, low to high for longs. The reason being is what I was just explaining up here on the top right-hand corner. You want, for bullish, swing low to swing high because we're waiting for the retracement to come down into our area and continue. We're catching what's called a continuation in the market. There's an impulse, correction, continuation. That is very important to understand. Impulse, correction, continuation. Being that we've already identified what the trend and what the direction is in any market, the 3 words after that are impulse, correction, and continuation. When I say it in my mind, I literally see market structure forming. This is impulse, correction, continuation. We're catching the continuation. That's our job as price action traders. That's what you're learning to become. a price action trader, a technical analyst, right? We want impulse, correction, continuation. All day, every day, this is what the market does. It doesn't do anything else. Even when it's moving sideways, there are small little impulses that are irrelevant to us, but they're in there. There are small little impulses, corrections, and continuations in the market. They're happening all the time in multiple time frames all the time. So you keep those three words locked in your head, and it'll help you lock this strategy down. So let's get into before I move to the next one. Does anybody have any questions on how to draw the Fibonacci correctly? And we're going to get into the examples on the chart. But from what I was just going over, anybody need me to repeat anything?
I don't know if it's repeat, but I do find myself sometimes, like, let's say, setting up a play just like this in an hour or 4 hours. And I
Yeah.
find myself thinking, like, do I use it? Do I use point A, like where it didn't retrace, like ever come back to it? Or do I just stick to our candles? Because there's times that an hour candle, there's two of them above the area I would normally put it, which is the bottom point eight. So I don't know, is there a way of kind of finding that way, or that mistake that I'm making continuously? Let's say there's four candles and those four candles are all hourly, right?
Got you. Yeah, yeah.
If I go into smaller time frames, I never noticed that the bottom point A never retraced. It never came back to confirm. So I think I find myself sometimes going up two candles in order to start the 1 hour candle. Does that make
Okay.
sense?
So you're just referring to how to adjust the fib correctly. That's what you're
Yeah, that
talking
could be
about.
it.
Like
Yeah.
I chose, since there are like 2 points at whatever, let's call it point A, right? Let's say
I think
there's
you call it a leg, right?
that is the
Like a
leg.
leg.
That leg is
Mhm.
also another term for it is called the impulse.
Okay.
That's a leg. You know what I mean?
Yeah. Hmm.
So you're just referring to if there's multiple options at the swing low. Like let's say you're going for long, and
Hmm.
what your situation is happening is that you tend to continuously pick the wrong wick.
Yeah, let's say it's an hour play, right? And
Yep.
it just never retraces. So now we got 4 hours of candles and it never retraced. So I'm still waiting for the leg to end so I could put B, right?
Okay.
It never usually comes back unless it's like a drastic pullback, but it never comes back because what it does, it breaks structure. So it comes back just to structure and it leaves me. So I can never catch the play
That
unless I chase it.
that's a
So,
that sounds like a matter of timing. What could be
okay.
happening is that you might have gotten to the play late and it's already running. And
Hmm.
you just don't realize that because you as the trader just got to the chart and you're looking for the play. But
Hmm.
you may not have, and I don't know if you're doing this or not, but you may not have looked far back enough to like readjust where that leg came from to see if that was the actual play and you should have been in the market earlier in order to catch that.
Hmm.
The
Hmm.
market the market will always retrace. Even if you think it's never going to, it's always going to retrace at some point in time. That's what I was referring to earlier. You have to wait because
Yeah.
you never know when it's going to do it. But now that, like for you, for instance, in that situation, now what you have to do is you have to adjust to the new impulse, and you have to adjust to that whenever
Okay.
it decides to come back. Whenever it decides
Which,
to come back, whenever it stops making that high, and that high turns
mhm.
into the new higher high by
Yeah.
the confirmation of the market breaking structure down to the downside,
Hmm.
that's when you can finally leave your point B in place. And then you can start looking for your area of interest within the fib retracement zones. You understand what I'm telling
Okay.
you? Like
Yeah. Yeah.
that could just be happening because you missed it. And what you're
Hmm.
experiencing, what you're watching in front of you is literally the play already in motion.
Hmm.
You guys never heard me say, "Oh, we missed it. That play's already moving. There's nothing to do."
Yeah.
That's because I missed it. Because we miss plays all the time. We get to the market by 8. I'm setting up a whole situation and it's just not coming back. It's just not coming back. It just wants to keep running for that day, especially in the indexes and gold. It tends to do that a lot. But and that whole play started at like 6 or 7 in the morning, and there's nothing we can do about it. And if you recall, like Tommy knows this, and Kevin's been seeing it lately, I have to start adjusting the entry zone. I'll set the whole play, entry area and everything, but the market keeps moving. So I have to adjust point B. As if it keeps moving, point B has to keep getting adjusted.
And that's maybe my question. So do you never move point A unless, even if let's say you're at an hour play, you go to the 15-minute play, and you could clearly say that in the 15-minute candles, it did retrace the 618. And that's your confirmation, right? So that means they already moved. So now that point A moves to it goes to that new bottom, which is the confirmation already, right? Is that correct?
Yeah.
So I'm getting that right. I'm saying that right. Okay.
Yeah. And the thing is too, like it could look like that in the 15-minute, but in the 1 hour, it
doesn't look like that.
It's still one clean candle, straight up.
Yeah.
You just that's the
so
dynamics.
What do you do in that point?
Those are the dynamics of the market. And what I would do at that point is I would focus on the 1 hour, not the 15-minute. No matter what, I'm focusing
clearly
on
1 hour coming back to you, basically.
Yeah.
Gotcha.
I would have to wait for the 1 hour chart to start coming back to me in that instance.
Even if it confirmed in a smaller time frame, because I think I get caught in those candles. That's what happens. I get caught in them because I'm thinking it already retraced. It's not going to retrace again.
Like, let's say you were in the long, like we were talking about. Let's say you did adjust your fib to the higher levels, but when it does come back for retracement, it blasts through your 618, and it's actually going for the higher time frame 618, which is at a lower point for the continuation to go. So that's why it's more important to focus on a higher time frame versus lower, because like I said before in the market structure lesson, the lower time frames tend to have more fake outs and situations that you'll get trapped in, when all you really had to do is focus on the higher time frame, and you'll see the complete picture overall. You'll see the complete picture, and then you can base your analysis off of that. So that'll help you not pick the wrong zones.
Yeah,
that'll help you. And again, this market is dynamic, so it's always doing it in some different type of form. So the more experience you gain in a specific ticker, like I told you, like you got to chop down those 90 assets to like a 4-pack, and it'll help progress your experience faster. So if you focus on, like I tell people, just pick one asset and focus on that, and you're going to get your entire skill set locked in. From there, you can start adding different assets. When I started 30 different pairs on Forex. I was trading nothing but currencies, right? And I was trading 30 of them all at the same time. Not active in them, but I was analyzing all of them all at the same time.
Yeah.
And what it does is it just, you don't know it, but it's affecting your subconscious ability to think straight, because you just finished analyzing something over here for 30 minutes, but you don't know that subconsciously in the back of your mind, you just took that analysis and came over here with a kind of a bearish bias on a market that's now long. So it'll affect you too. That's why focusing in and dialing in on just a few pairs. If you're just starting out, just 2 max. But that's going to help you progress faster. You know what I mean? So you're not being like, all right, I'm on 3 assets over here, or on 30 assets over here, I'm long. On these over here, I'm short. It creates a mess mentally, because now you have to manage all of that. And in order to manage that magnitude of different assets, you have to have experience. Like I can do it, and I still choose not to do it. It's just too much. It's just too much. But once you dial them down and like start focusing, I mean, for you, because you've got so many going on, 10 to 20 will help you out. if you're managing that many properly right now. All right. So does that answer your question, what we were talking about before, though?
Yeah, I think like we said, it's like during class, I think I'll be able to get the questions that I have
Yeah, because
answered.
we're gonna get into the charts back here, and
Yeah.
I'm gonna show you guys the examples.
Okay.
So let's go into step 4, which are the key Fibonacci levels. These are the focus that you focus. These are the levels that you focus on for Fibonacci. I'm going to explain what each level means. All right. The 38.2. That importance. Its importance is that it's signifying a shallow retracement. The 38.2% level on the Fibonacci signifies a shallow retracement, meaning this. Like just a short retracement versus overall. And let me put this lower so you can see. This is probably a 38.2 here. If I go to point A, point B, that's a shallow retracement. And I just eyeballed it. That's how long I've been using it. I can eyeball them and see. This is what you consider a shallow retracement.
You see how you put a point A all the way up there?
Uh-huh.
Now, explain that. Yeah, why there?
I can. Well, that's what we were just explaining earlier.
Yeah.
I'm just using this as an example to show you, to visually show you
so that's not the correct way. You're just showing.
Yeah, I'm just showing you what this means.
I was about to say that shit confused me, but cool. I got it now. You're just
so
showing.
Would you place it on the bottom?
Yeah, you would place it on the bottom.
You can do this in specific situations. Like if you are trading on the lower time frame, it can be used. And we'll get into the dynamics. That's why I was saying earlier, the market itself is so dynamic that you have to adjust. And once you get more experience with the market structure and picking the proper points, the better you get with the Fibonacci itself, right? So this is what's considered a shallow retracement right here, the 38.2. There's nothing wrong with the 38.2, but you have to understand that with a shallow retracement, there is also risk for a steeper retracement. This is why I always focus on the 618, and we'll get to that one in a minute. But a shallow retracement, it doesn't. This just signifies that the market is continuing, because with the shallow retracement, the market didn't give a full retracement, which it happens all the time, and it's just continuing. And if you look at it over here, you'll see that it just looks like this. It gave us a bearish engulfing, but then it immediately went right back up, right?
Mm-hmm.
You have to understand the type of asset that you're trading to. When you do pick your assets, you need to back test and get into the history of the market and start placing your fibs and start, I would say you could journal it or keep mental notes, depending on how good you are with your memory, but see which one it likes to hit the most. Does that asset like to use the 618 a lot? Or does it like to retrace only to the 38.2 and continue? Every asset behaves differently. So that's why it's important to understand what these levels are and what kind of asset you're trading. All of the assets that I trade are magnetized to the 618. That's not by accident. I chose that because it keeps me in uniform operations when I'm looking for analysis. I already know I only want a 618 retracement. Do I ever send you guys a 38.2? Never. Does the asset always blow through the 38.2? Constantly. It doesn't mean it won't use the 38.2. It'll use it, but more than likely, it'll use it as a rejection point and then come back for further extension down to the 618, which brings me to the 50%. The 50% is what's called an institutional midpoint, meaning this is where the markets like to balance out. This line right here, if you guys can see it clearly, let me make it thicker. Yeah, that's good right there. Let me take it back here. This is what's called the 50% mark on the Fibonacci tool is what's considered the institutional midpoint. Some markets like to come here just to balance the market out and continue from there. Even the NASDAQ will use this as a balancing point because markets need to go up and down in order for the market to work. It's picking up orders on the way up and picking up orders on the way down, collecting liquidity on the way up and down, right? I don't use this at all. I don't use it at all. Not in the way that I analyze the assets that I've chosen. Because like I said before, I know that these markets tend to give me 618 retracements. All right. So now let's get into the 618. The 61.8% on the fib is what's known as the golden zone. I don't know why they call it the golden zone, but it's called the golden zone. It's a Fibonacci term. It's my favorite level. It's where all the money is made with every asset that I choose to trade. This level right here is I call it the money line. This level right here is where I gain the most precision in all of my entries. Even today, Kevin and Tommy saw we traded gold. I don't even know if there was drawdown, but all I saw was profits. And it went straight up into TP2, TP1, and everybody made money. Gold is another asset that likes to use the 618 as a retracement. Most of the pairs that I see that likes to use a 38.2, a shallow retracement, are Forex pairs. Forex pairs tend to trade that. But when you're trading indexes, it's typically the 618 because indexes have deeper retracements. It's not the deepest retracement zone, but it is the money line. The deepest retracement is called the 786%. The 78.6% is the deep retracement zone, and that is this blue line that I have down here. Sometimes the market will react at the 618, but then continue to fall down to the 786 in order to, I guess, collect more liquidity, if that makes sense to you guys, before it continues. I don't even know if this setup went to the 786, but I think it went to the 618. You got in the area. Let's see. Yeah. Got into the area right here. Look. Got right into it. Look, it gave you one shallow retracement on the 38.2 and then dumped. Hesitated on the 50% and then came right into the 618 and decided to use the momentum to break structure. It does this constantly. I don't even want to give a percentage up, but it does this constantly. And it took me a long time to understand this. It took me years to just give in to the fact that, yes, this works. Yes, this is where the money's made. Yes, all I got to do is wait for the price action to come to me. If I learn how to use patience, which is another thing that took me a long time, if I learn how to use patience, all I got to do is wait for the market to come to me, and then I can profit off of the continuation, which is what you're seeing right here. This is the impulse, correction, continuation. This is typically where all the money is made right here. Look, it barely went into drawdown. I don't even consider that drawdown, but like, okay, a smidget of the wick went into drawdown and then we went into profits. This is extremely powerful to accept and understand. What do you guys think is going to take for you guys to apply this? There's a word that is used in order to think something is true and it does work. The one thing that you need to work on for you to use this properly. It's not market structure.
Oh, believe in it.
You have to believe in it. You have to believe. You have to believe trading works anyways, because first of all, you got to be a little bit crazy to want to be a day trader. That's just facts, because this thing will break you down in ways that you've never even thought before. You're going to look at yourself as a loser and all this, that, and the third. But the only thing that's going to take you through it is believing that the strategy works. Understanding market structure as much as possible is going to get you to the belief level that you need to be in order to wait for setups like this to come to you, and then you take the action. You got to have the courage enough for it to come to you and wait and enter no matter what. That's what we did today. That's a prime example today. And it was a high risk day today because we had high impact news during the market. And what did the news do? It came to us, ticked us in. It just breathed on the 618 and then it just launched off.
What was the news?
The news was Jolt's job openings. It's a high impact news, like it's high impact economic news.
Right.
It didn't even, for most of the time, like it'll crank up the market, but it came in nice and smooth. It came in smoother than I expected because of what the readings were. I guess it came out positive. Anyways, we went long, so we were good. So
a quick question. So for this to work, we would have to place the level where you placed it at. But I would place it because in the previous thing you said you start on the low swing from the low part of the swing to the top of the swing. The low part of the swing, I would say, is at the 2 oranges to the left.
Right down here.
Right here. I mean, you can't see my thing, but like
this one right here.
No, like two, like where you placed it. Now go two candlesticks to the left.
This side, this way?
No, left.
Left is behind you.
1, 2. There you go. I would say that's the bottom of the swing, right?
Okay.
That is the levels for everything.
That is not the bottom of the swing, because
that is not.
The only reason, and the reason why, is because the Fibonacci is placed with fibs. I'm sorry, the Fibonacci is placed with, the Fibonacci is placed on wicks. So what you're ignoring is this wick right here.
That's what I would put mine.
Right.
That's why I asked you, how did you, or why did you put it up there?
Well, I didn't even take this play. I'm just giving you this example.
Okay.
Or to explain to you the different levels of the Fibonacci. The real play was down here.
What I'm saying. Oh, okay.
The real play was down here.
I think that's what's confusing.
This is after the play left. This is after the play left. The real play is over here. This is the real play. That's the play.
But it already happened.
But it already happened. So chasing it, you know what I feel about chasing. Chasing it puts you at levels of risk that if you aren't experienced enough, it'll get you more losses than wins. That's why I say don't chase it, because if you notice, this entry here was nice and smooth. It picked up all of the orders here and it just left and never came back. The only time it retraced was after it broke structure right here. And then it did what? Retested the structure and then continued. All of this right here, this is just everybody who was in this play decided to start collecting the money. Let me adjust this.
Yeah, that's what I do. So let's say that play happens, and then I'll move my point A to that area that you're doing now. And then for some reason, it retraces back. I buy it because I'm chasing it, right? Because I see the play is actually working. So I'm like, okay, let me jump in. Let me run it to like 618 or structure. When I do that, it always retraces. And guess what I have to do is pull my fib back just to see if it's going to respect that area again. And most of the time, guess what it does? It passes it.
It does.
Because it's already the play done.
Well, what time frame are you doing it in?
A lot of
that would usually I would go down to like 15 minutes if I'm actually managing it because I'm already in the play now.
Yeah.
Because I saw the play started.
A lot of the time, price tends to retest an area it just rejected because that's it has a natural tendency to do that. Whenever price rejects somewhere, it'll have a natural tendency to reject it at times. It doesn't do it all the time, but if you're caught in the retest of the area, that's what you're gonna experience. So that's exactly what you're experiencing. You get what I'm saying?
That's what. Yeah.
So it's not your fault. It's just experience. Once you understand that the play already left, you shouldn't be chasing it in these areas. You should be looking for legs to finish, right? And readjusting. Like, I don't know if it's going to happen, but let's see if this works. So this was the original 618 retracement. Boom.
Correct.
Point A.
Boom.
Now
and
we got
point B.
Point B up here.
We've already
got a shallow retracement. Right?
To 3. 10. Yeah, the 38.
The market has a tendency that once it's already in motion, it will use 38.2s as retracements to continue because it's already creating the new leg, the impulse that broke this structure here, right? So all we could do is wait and see if it's going to use a lower level to retrace to, but sometimes it just uses this. So I don't know if it's going to. Let's see. Let's take a look at it. Created a new high instead. It just kept going. So this is what you call missed. You missed it already. The play was down here. You shouldn't be doing anything up here.
Yep. That's my issue, now, and I don't know how to correct.
Of course, this worked out. Let me go here. Of course, this worked out. You know, but that means that now you're trading at a lower time frame. So when you're trading at a lower time frame, that creates a higher risk when we're doing these plays, because these plays come from top-down analysis. They come from higher time frames. You get what I mean? You do have in trading, it's always 50-50. You always have a 50-50 chance of your trade working out. I don't care how good you are. Even I have an 80% win rate. And I know for a fact that it still could be a loser. But I've accepted that fact because I believe in the strategy and it works 80% of the time.
So, Carlos, you said you're trying to figure out why he keeps choosing that point right there?
Yeah.
Yeah.
That's the next choosing that higher point. Low. That's the next higher low.
This right here is the next higher low. But what he's explaining is he's been experiencing losses every time he tries to do that.
Correct.
And that's just from experience in market structure. That's all that is. It has to tell you what it wants to do. It's breaking it. Like this one ended up working out. This one would have been one of those 50% times that the trade does work out. But a lot of the times what you were explaining was that it goes all the way back.
Yeah, it comes back to where it retests the 618, which is the beginning move.
That's the other 50% of the side of the trade. You don't know when it's gonna want to come all the way back and then continue. Tommy, how many times have we been in trades where we enter here, we're all the way in profit in TP2, and then it comes all the way back, and then it goes all the way to TP3 and beyond?
Yes, like a double top.
So it happens all the time, bro. Happens all the time.
I think I had asked that question because I noticed it more often than none, and especially in like lower time frames, it comes back to retest the areas like a double bottom and a double top. It does that for liquidity and to knock everybody out before it does the actual move. I've noticed that. Yeah.
That's why I focus on getting up
higher time frames.
Higher time frames for sure, but getting up early enough and being on time on the charts. I'm not saying that you aren't. I'm just explaining what it is that I do. That's why I have a high success rate. It's because I'm always in front of the charts on time. Before the moves happen, I'm already looking at the analysis. First of all, I've already got my key levels and I've been trading the markets all year long. So I already have a very good idea on what the market may do the next morning. If we've
Mm-hmm.
been trading long all week and we're just creating higher highs and higher lows and breaking structure all week, and I wake up in the morning and it's still doing that, I'm only looking for longs until the change of character on a higher time frame tells me that, okay, it might be time to look for shorts. And then we short.
Another thing I wanted to ask, which I'm sure with your experience you learned, I become patient, right? So in that patient moment, I notice the market it runs, right? And I'm like, but I'm waiting it for it to retrace so I could get in. And I continue as day and a day and another day, and it's just running. It just leaves you.
Yeah.
And you finally get in, and that's where it pulls back, which it happened to me today. I was being patient. I think yesterday I finally found an entry. I jumped in and a few like option plays, and this morning it just pulled the rug on most assets. So I
Well,
ask you, if I continue doing that, what is it something that I could do to get better at that, if that makes
well,
sense?
the answer to that is to look left, meaning
Okay.
you want to look into the history of the market. Like whatever, like this is an all-time high, so you're not going to see it. But let's go down here, right? Let's go down. The answer to most of your issues, if those markets aren't in uncharted territories, like let's say it's in these territories, right? Let's say it's over here, stuff like that.
Mm-hmm.
Let's use this as an example. You see how this was the last high, this area right here, right?
Mm-hmm.
Let me highlight my arrow. This was the last high. If you're not looking left and you're just trading this, and all you see is breaks of structure, higher highs, lows, higher highs, lows, higher highs, lows, right? And you don't know that this is actually market structure to the left, then you won't be ready for the rejection that could happen to you while you're going long. You understand what I'm trying to tell you?
Yeah, yeah.
Like that's a case that
I mean, even if you look at that the example you just gave there, notice that if you look left going down, it continued doing higher highs, higher lows. In my example, I would have caught it on the top up there. Look up above
up
that
here,
market, above the market structure.
up
Continue
here.
going up right there. So let's say I would have seen the structures telling you up, down, up, down, up, down,
Mm-hmm.
and then I buy there, and then wham, it actually takes me like that. So how can I get better at that if your experience allowed you to see that clearer than me?
Well, it's like I said, you have to have your key levels set because I've got key levels here and I wouldn't have bought right there. You get what I mean? Because I already know this is a key level, right?
Gotcha.
I don't know if there's market structure back here because we're at all-time highs. Let me see.
Mm-hmm. No, there's not.
This is an example of that. But in
Yeah.
your case, you always want to look left to see what it is that the market is running into. Like back to this example, you always
Gotcha.
want to find out what the market is running into, because typically, if the market is running into its last high that it created, and that high that it created made the market react in a bearish,
Mm-hmm.
turn it into a bearish trend, then
Mm-hmm.
you need to expect a similar reaction when the market does get here.
Yeah. And when it did, which you could see it there, that's where I would sell because it's starting to show me bearish candle, things like that. What is it called again? When it engulfing bearish candle right there. And
Yeah.
then notice what it did. Popped above it, and that's where it
Yeah,
created an
after 6 hours, it popped open.
yeah, yeah.
But the entire day, the market was bearish because of
Yeah.
the key level. You get what I mean? So
Mm-hmm.
if you were to go long here, you're in trouble.
Yeah.
You get what I mean?
That's what I'm feeling like I'm jumping into
You
all the time.
you have to work on your patience. Is what it
Okay,
is.
but so at that point it broke through resistance So now we know, not for sure, but pretty well that now we're in a bullish market, right? And
The
that
word
chart's
is
It was
Yeah.
always in a bullish.
the word
no,
is the probability is that we're in still in a bullish market.
well,
Any
look,
types
zoom
of
out for a second. If you
say it again.
zoom out for a second, like we saw it. So like it was bearish for a minute there, like that peak on the left, and then it dropped all the way down. Like
He's
keep
talking
going.
about below it.
Yeah,
Jose.
Yeah,
it's down here.
Yeah,
Yeah.
that.
but
Yeah.
that's pretty long time of, I guess, I don't
hmm
know what's the time frame of this? Oh, it's only 2
This is
hours.
the 2 hour chart. This is the 2 hour chart.
Oh, yeah. So I guess
That's
that's
a
not.
really long time.
Yeah.
This bearish trend started
It's probably like a
developing
day.
on the 14th and didn't stop until the 20th. So 6 days.
Right.
This is a
And
6
then
day
now we're gonna
bearish
go
trend.
up. We're gonna go up and test that point up there, and then if it rejects that, then we could be in a bearish market. But now that it's going, up, that really
Yeah,
signifies that.
that's the
So
thing.
then what do you do at that point?
That's the thing. You don't know. And you have to accept the fact that you don't know. You have to
Right.
wait for the market to tell you what it wants to do. So
Right.
like in the market structure class, the fact that this didn't break below the last low and close candles down here would have told me that there's still a possibility we're in a bullish trend. But I don't do anything in those cases. I wait.
Wait,
What happened after that? This was what, the 22nd, then the 24th, 2 days later. So this was a weekend right here, this gap.
Yeah.
The
He
market
waits for the
closed on a
retrace.
Friday and it opened on Sunday night in a gap bullish, broke to the upside and continued the bullish trend. So
So now,
there was nothing to do here unless you dial down to the lower time frames, and I'm sure you could have found the short, which would have been a great area to short. You get what I mean? But
Market structure.
because, to answer your question, Kevin, because the market never closed below and broke structure to the downside, there's a high probability that it still wants to go up. You have to wait for the market to show you and confirm to you what it wants to do.
right. So then, but once you get that confirmation, now it's probably a good time to put the Fibonacci. Let's say, okay, I think it's going long. So now I'd put the Fibonacci at the first blue candle that
you could do since this was the market open. This is probably like a 786 right here. So
that retracement is where I'd want to get in at.
Correct.
The what?
That retracement is where I want to get in at. So because I want to see if that comes
This
back
over here.
No, the one on the right. Like I've already seen this.
Oh, over here.
Yeah.
Okay. Gotcha.
He's asking you, I think.
Yeah, I'm just saying that to me that would make this most sense.
You're asking me, this would have been the retracement you wanted to get in at.
Yeah.
Yeah. So you would have seen the market open here, which would have been your low, right?
Yeah.
That's point A. And for Fibonacci's going long, you go from the swing low to the swing high.
Yeah, but that doesn't exist yet.
It doesn't exist. I'm just painting it out for you. It doesn't exist yet. So what do you guys see?
I would have done the bottom of the yellow candle, which was below the break of structure.
That's only because of experience. You don't know, or you didn't know that using the session candles, the last close, the last open, of the candle, that's where you start at, and that's how you catch big moves like this. Like if we were to use yours, we're waiting all the way down here, and it never comes. Technically and naturally speaking, you're waiting for market structure to start, right? But it already broke market structure, and this is now the new low that you use.
That's I think the issue I'm getting.
Yeah,
that's okay. That's just experience. Now you know.
So where it breaks structure, that is your candle, and you start 1 hour, 4 hour.
No, I'm just referring to when markets have closed and have now opened. That is your new starting point for the rest. That's what I'm explaining to you. This was Friday. This orange candle here. This is Sunday. This is where you start from in this case.
Correct.
Let's say all of these candles were full. There was no gap. then I would have used this, and there was a probability that it would have came back to retest the structure here.
Right.
You understand what I'm saying? That's how dynamic it gets. You have to dance around with it. And I keep reiterating it. The more experience you get with market structure, the better you're going to get with the Fibonacci, because this is one hell of a play. But you would have missed it thinking you have to start at this low.
Yeah, that's what I would have done.
But if you didn't realize that these two candles are 2 days apart, even though this is a 2-hour chart, you don't know. So you start here thinking it's going to come all the way down here. And who knows?
Yeah, but
It may
that's
have.
a gap fill. It should come back to that.
I was expecting a gap fill too. I think Tommy was in one of those plays that I sent, and it never came to the gap. This was the gap that we were waiting for too.
Yeah.
So.
Yeah, it's like you have to be nimble. You know, it's whatever it tells you. It's not a set in stone thing. Because right there, that's confusing. Wait, hold on.
You know, the best way to the best way to move in the markets is just to have an open mindset. Never come in the markets already thinking what you want to do. You should come to the market with a clean mindset and allow the market to start filling your mind with the information that you need to use in order to create a good technical analysis. Because if you come into the market, I feel like shorting the market today, you're going to get clapped. Just because you feel like, or you think like, or something's telling you that you should short doesn't mean that you're right. You don't know anything. I know that I don't know anything. That's why I trade so good, because I always come in with the mindset that I don't know what's happening today. That's what I mean by I don't know nothing. It's not that I don't know how to trade. Obviously, I do. But I always come in with a clear mindset and allow the market to start giving me the information and the data that I need to analyze in order to understand what's happening in the market, what is the highest probability that this market is going to continue in the direction that I found, and where should I place my entries. I let the market and the price action tell me what to do. That's why I'm so good, because I don't have an ego when I come to the market. I'm not saying that you guys do, but when it comes to the market, she will humble you in ways you've never known. I promise you that. The market will humble you in ways you've never felt since you were a child. I promise you that, guys. You know how I know? Because I've been there.
I've been there too, yep.
Sleepless nights, understanding that you, or just feeling like that you are a loser because you didn't follow your rules and you just feel beat, man. I'm talking about beat. And you thought you really had it. And because you thought you really had it, you went in heavy and you blew your account multiple times. Multiple times. So when you feel, we're dudes. So there's a bunch of dudes on this chat right now. We have a tendency to learn the hard way. And in this market, you're gonna learn the hard way if you don't do exactly what it is that I'm teaching you right now. The reason I'm teaching it to you like this, so simple and making it so easy to digest, is because I've taken all the fluff away so that I don't fill your head with a bunch of things you don't need to think about. If I wanted to, I could get extremely complicated. I can get extremely complicated in this. And then it's going to make it harder for you guys to progress because you're just digesting sophisticated material. We don't have time for that. We're here to make money. So the whole point of everything that I'm teaching you guys is to get to the bag faster. And in order to get to the bag faster, just follow the strategy. And I can tell you this, the more you study and the more time you put into back testing, meaning going back into the markets and looking for setups and placing your key levels and studying market structure, the better it is going to be for your confidence. Your confidence is boosted. You're going to believe in it more. The more you believe in it, the more money you make. Because I have a winning strategy. I know it's a winning strategy because I win from it. And you guys see it all the time. The reason why is because I believe in the entries I send. Not only that, I never send anything I'm not in personally. So I'm sweating with you guys when we're in drawdown. All right. It's not just you guys sweating. I'm over here. Damn, I'm down 2,000. Oh, fuck it. You get what I mean? But that's due to experience. I can say fuck it because I still believe it. Even when price is coming negative into our, let's say our entry was up here and we're experiencing all of this drawdown. Even when we're in this type of drawdown, I'm sipping my coffee, boys. Do you know why?
You know your
Your key levels, you know that it hasn't broken structure. You know that you have an exit or stop limit at that point, and it hasn't hit that. Good.
All of that, plus I've already made my analysis, so I have to stick to my plan. When I first started trading, I would make great analysis, and you know what I would do? As soon as it's in drawdown, I'm closing it. Oh shit! Oh, it's too hot. It's too hot.
Yeah.
Oh, fuck this. And then when it gets in profit, I get back in and I'm at a terrible entry. And then it gives me drawdown. And then I get out again, wait for bullish, start chasing. And it's a bad cycle to be in. When all you really have to do is just let the trade be in drawdown. Let it be in drawdown. You've already accepted the risk. You've already accepted everything about the play. You like your analysis, so you stick to it. The term is plan the trade, trade the plan. That means plan the trade, get your analysis, and once you're in, trade the plan. Let it rock. Let it go to your TP. You know, you just have to develop a level of conviction in trading that becomes profitable. When you don't have any conviction and you don't believe in it, you're going to be closing a bunch of trades as soon as you see red. And that's okay when you're just starting out. It's going to happen. I've done it. I've been there. Now, I don't care. I take my L's and I just keep going because I've already allocated the proper risk that's not going to blow my account. I still have plenty of shots left in the clip. That's okay. If I take this L, what happens every time we take an L, Tommy? What happens on the next play? I don't even know if he's on here. Oh, no,
Yeah, we make it right back.
Oh, there you go.
Take a loss and make it right back.
We take a loss, and then we get into the next play, and we make the loss back, plus double or triple what we made.
Yep.
Depending on where you get out. And it happens all the time. Why? Because I believe the strategy works. And the strategy does work. It works all the time, 80% of the time.
It's also kind of built into the equation of where you put your stop loss and your take profit. If you have a 3-to-1, ratio,
correct,
and then you're winning 80% of the time, you're almost looking for the loss just so you can get back to winning.
You just like, I don't care. You get you'll get into that what's the word I'm looking for? That workflow where you just know, man. You'll start getting so good that losses don't bother you. Not saying it doesn't make you itch and scratch like nobody likes to see red. We're human. We're going to behave as humans do when we take losses. But the better you get at taking losses, the more profitable you become. What they say is the best losers and traders are the most profitable. As crazy as that sounds in the regular world. In the trader world, to be a profitable trader, you have to be a good loser. First, you have to accept losses in order to become a profitable trader. Otherwise, you're never going to get there, and you're just going to be on a hamster wheel, going in circles every time. So let's move forward on this. And it's like, again, I'll reiterate, the 618 and the 50% are the high quality trend continuation trades. I'll say it again, the 50% and the 618, which is the ones that we use, the 618% are where all of the high quality continuation trades do. And what kind of trades do we take? Continuation trades. We wait for the correction. We wait for the pullbacks. It all means the same thing. Pullback, correction, continuation. We wait for the continuation.
And that all happens after the impulse, which I like that word because that helps me see what's happening.
Good. You're talking about impulse, right?
The impulse move, like the two
Yeah.
blue candles right there, basically.
Yeah. And look, this is impulse. Ping, ping. Impulse. Correction. Continuation. And I'll draw it out too. So this is impulse. Correction. Continuation. Just like that. This is the key to the strategy. What you guys are looking at right now, Kevin's like, what the fuck? That's it? Kevin's new to trading, guys, if you didn't know. Like, he's starting from scratch. But I'm going to tell you right now, I'm going to turn him into a hell of a trader because he wants to do it just like you guys. So he's going to bang it out with us. This right here, what you guys are looking at, is the bread and butter of my strategy. This is all we do. We look for this pattern continuously. We wait for the impulse. We wait for the continuation, the correction, and then we jump in on the continuation. Once again, we wait for the impulse. We wait for the correction, and we jump in on the continuation. Every week. Tommy, I'm going to ask Tommy this. Have we had a losing week in the chat since the year began?
No, definitely not. No. And forget the year began. You haven't had one in years.
I haven't had one in years, guys. I haven't had a losing week in years. Do we take losses? Of course we do.
It's part of the game.
Losses are part of the game. It goes back to being a good loser. We win so well because we lose so good. I haven't had a losing week in years. Do I promote that? Fuck no. Because then people are going to expect that. And it's not like I'm shooting for that. I'm not shooting for immaculate records at all. That's why I don't promote it. Because at any point in time, anything can happen in the market they're not behaving well. It's happened before. But it's because I'm so disciplined with this simple aspect of the strategy and developed monk-like patience. And mind you, I was not a patient man before, but I'm very patient. What would be your...
My bad. This is Tristan with David.
My bad. What's up, David?
I'm going to interrupt. It's Tristan. I'm with David right now. I just have a quick question.
Yeah.
And what would be your definition of a good loser? Like, how would you...
A good loser?
Yeah, what does a good loser do?
It's like what I said before. A good loser accepts his losses. You take your licks and you move on to the next setup. That's a good loser. A good loser does not chase trades. That makes you a worse loser. A good loser accepts the fact that his setup did not work and waits for the next setup to show up. It's like I tell these guys in the chat all the time. Oh shit, we took an L today. Don't worry about it. I'm going to look for another setup. We'll find one either today or tomorrow. And there's a high probability that that one becomes the winner. We erase losses and we're back in profits. So a good loser is just somebody who accepts the fact that the trade did not work out. Because there's always, in trading, a 50-50% chance the trade still won't work. Everything can line up. You're like, shit, I used everything in the strategy. Everything worked. And this shit can still be a loser. For whatever reason, the market is dynamic and you can't control it. You're not in control of these markets. As much as people have told me, oh, you're a fortune teller, you can see the future. No, the fuck I cannot.
What does a good winner look like? You know, I feel like sometimes some people will win and then they size in heavy. They take trades that, you know, seem like they're B plus, C plus, instead of sitting down, waiting and being patient like they were, you know, because I feel like sometimes when I start getting on a roll or I start getting on a ball, you know, obviously I start to feel like I'm getting more of a handle of things and, you know, things start to just, you know, go out of my mind that I should have double checked. Like, oh man, if I just checked this, then this would have been the play here, etc.
A good winner is simply somebody who follows all of the rules even when he loses. That's what a good winner is. A good winner is somebody who sticks to the plan even when he's losing. Period. A good winner is somebody who plans the trade and trades the plan. Does not look left or right just because something else popped up. You have your strategy, you stick to the rules, and you execute and you follow through. That's all. It's just one word, really. It's just discipline. A good winner is a disciplined trader. There's no secret. It's very simple. If you have your strategy in place, you've got the steps down. You found your confirmations. You found your entry. You've planned your trade. Now it's time to trade your plan with conviction. You believe in it? Hey, let it rock. That's a good winner. That's a good winner, if that makes sense. I hope that answers your question.
Amen. I appreciate it, brother. Always.
Yeah. All right. So let's go to step number 4. But before we do, does anybody else have any questions? Anybody?
I mean, I'm still a little confused as to where to place the Fibonacci sequence because you're kind of using it because you go through the impulse, then the correction, and then so you waited for the correction so now is where you want to place the Fibonacci sequence, right?
That's what we're gonna get to now. We're gonna combine the fib with structure.
Yeah.
You're asking a question, how do I place the fib on top of market structure? That's your actual question. That's what we're about to get into right now. It's like where to place it. How do I know where to place it? That's what you're asking, right?
Yeah. Yeah.
Okay, perfect. So we're gonna get into step 4, which is combining the fib with structure. The number one rule in using the fib is don't just simply use the fib just because. Do not enter simply because price touches the 618. That's a conflicting thing coming out of my mouth because I'm a trader that uses limits. Why do you guys think that I use limit orders and I don't need to wait for price to confirm before I enter? Why do you guys think? Anybody? There's no wrong answer. Why do I wait? Why do I not have to wait for price to confirm?
Because if
You believe in your analysis.
What's that?
You believe in your analysis.
I believe in my what?
Analysis.
I believe in my analysis. Definitely. Definitely.
I was gonna say that if it for any reason just doesn't play out, then it's probably going the other direction. And
yep, there's that too.
There's no need to put the human emotion of should I press this button now? Should I press it now? Entering in early when you just have it set there, it taps right into it. You believe in your analysis, then it should play out. And if it doesn't play out, then like you said, you can look for the next one.
Correct. The reason why I do that, and I have the ability to do that, is because I used to wait for confirmation before I entered trades. But it goes back to market structure. I got so good at market structure, guys, that my analysis has a high probability win rate. So I'll use an example here, right? I'll use an example like this. And we're going to get into step 4, but this is going to be the example of step 4, right? This was the 618, right? This was a 618, right? Let's go down to, we can go down to the 30. The reason why I use limits is because waiting for price to confirm that it's about to go in your favor is going to make you miss the play a lot of the times. Not all the time.
Just like half a second wick down that gets in there and then boom.
Sometimes it does that. Sometimes it just wicks us in and we're total profits. Like that happens a lot in the chat, right? The reason why you can choose either option, and I'm not telling you guys this because you shouldn't. I'm telling you guys this because if you're not comfortable with limits, most traders aren't. Most traders need to wait for confirmation that it is going in a direction before they enter. There's nothing wrong with that. But my analysis is so tight, it's so good that I no longer wait for that. I just need price to get into my area and I'm banging. I just need price to get into my area and I'm banging because I believe in my analysis and all I'm doing is waiting now. So because of the conviction that I have and the experience of doing this for so many years, I've noticed I no longer need to wait for price action to confirm that it's going to go in my direction before I enter. What happens is if I wait for price to get here and then wait to give me confirmations, this down here is no longer my entry. This would probably be my entry somewhere around here. And this is getting into how to use limits and why I use limits, but it makes sense.
I just feel like with I was gonna say with just for example, like for me, when I back test, I only just back test using limits, limit orders on my key levels.
Yeah, you're used to using limits.
Of market structure. But when I'm trading in a live setting, I'm waking up at 9:30, 9:45, or I'm up at that time, I'm opening charts up, I'm ready to trade something. Something in me is telling me, hey, I'm wanting extra confirmation during price now when it's moving right now to get in instead of trusting the analysis, trusting, the key level or whatever the case is,
right,
or the play instead of just letting it run out. And that's made me, miss out on plays where I'm up and I'm watching it move. And then I'm like, oh, but I didn't, it's giving me a tiny tap and I'm wanting more confirmation. And then, it just runs without me.
That's understandable. I mean, to me, that just sounds like you need a little bit. I don't know how long you've been trading for, but you just may need a little bit more experience on reading the actual price action that's in front of you, which is what I'm about to get into. This goes into in case you do miss your limits. What do? Carlos has this issue too. Like, what do I do now? Do I chase it or do I just let it run? Sometimes the answer is don't do anything. Other times, price action is still in the area and it'll give you a bullish or bearish confirmation to get in, depending on the direction, obviously, that you're going to. So this is the 30-minute, right? Let's see. The 15 minutes not going to give us anything. Nope, nothing there. It just wicked us in, still left the wick. Let's go to the 5-minute. In the 5-minute, you would have to enter here. Can you guys see that?
Right, because it taps you in at the level, and then you have to if you decide that's where you want to go, that's where you have to tap in at.
But that's a perfect example of what I was just speaking about.
Yes, but this is a specific candle pattern. Does anybody know what this candle pattern is?
It's a bullish engulfing pattern, and then it confirms
bullish engulfing pattern. Now, this is a good way. This is the proper way to enter. This is how it's taught on the fundamental basis. This is where you enter, right? The way I enter, I help us gain, in this instance, over 300 ticks because we entered the way that I entered. So if you wait, price may give you another option, but you're entering 300 ticks above the entry level. Now, there's nothing wrong with that. Again, this is the proper way to do it. The Fibonacci is going to give you the entry area, and you're supposed to wait for price action to confirm that you're correct. In this case, you want to wait for bullish engulfing candles or patterns to confirm that your direction is correct. This is how you enter it properly, Carlos, right? Now, it also does this. It could do that. You could enter there and price will still come back down here. Price will still come back down here and may come down and draw down, and it may go down to the stop loss. See where I'm going with this, guys? it took me a while to accept limits. As a matter of fact, Fabrice is the one who just pounding it down in my head. Yo, just use limits. Your entries are too tight. Your entries are so tight, you don't need to wait for confirmation. It's always hitting your level. Just go to limits. And I ignored him for like a year. And he'll tell you this story too, until I just started using it. And what I found was freedom in using limits when it comes to the way that I enter trades, because I'm no longer in control, which gives me time to breathe. I just let the play out now. Now the setup is doing what it needs to do. And if it taps me in, great. If it doesn't tap me in, I accept that I'm not in the trade. Or I wait for bullish confirmation candles, in this case for longs. You guys understand what I'm saying? Like, I wait for the pattern to emerge first. So in this case, I would have had to wait 5 minutes because this is a 5-minute candle. It tapped everything in, left me at the entry. And in 5 minutes after the candle closes, not while the candle is open. Don't ever do these entries while the candle is open, because you do not know if the candle is going to open up here or if it's going to go back down to retest and retrace a little bit further. You wait for it to close. That's the secret. A lot of everything that we do and what I do in the chat is waiting. That's the secret when it comes to that. But I'm going to go over all of this right now so we can explain it in more detail. So this is going to help you out, Carlos, since sometimes you miss the entries or you're like, damn, should I enter now or what? We're going to go over that right now. All right.
Hey, real quick, while you're on that, which one's engulfing? So which one's engulfing which? What's exactly the definition of a bullish engulfing candle?
Okay, that's a good question. A bullish engulfing candle is, in this case, it's blue, right? The blue candle is bullish, and this orange candle here is bearish.
Right.
A bullish engulfing pattern is a bullish candle that closes larger than its previous candle. So it's just a candle that starts to print, and you wait for it to close to see if it will engulf the previous candle. As long as it's larger than the previous candle, it's considered engulfing.
And that signifies what?
That signifies a potential continuation.
Okay.
That's what that signifies.
The language of the candles. So those are things you'll start learning, but it kind of tells you, it's like a tip. It's like, hey, this wants to go up.
Yes. That's exactly what it is. You'll learn this one in the price action lesson that we did a few days ago. Okay. In the price action lesson, you will learn all of what I just said right there.
Gotcha.
Very easily. Everybody, that was a great lesson too. All right. So, like I'm saying, let's go back to scratch, and we're going to be using the example of waiting for confirmation before you enter after the 618 gets hit. Everybody clear on that? So you do not enter simply because price touches the 618. You wait for confirmation. In this case, it's long, so it's a bullish engulfing candle pattern. This is the confirmation you wait for after the 618 has been hit and rejected. You get it, Kevin?
Yeah.
Okay, perfect. All right. So you just wait for the confirmation. The bullish setup, obviously the market creates a higher high. You draw the fib from low to high. Price retraces either into the 50% or the 618%. Let's scratch the 50% because in this strategy, we're only focused on the 618. So price retraces into the 618. Price forms a higher low. Then a bullish confirmation appears, right? And then you enter long right here. Let's make this thicker. So I'll say it again. Price retraces into the 618, right? Price forms the higher low, right? And then the bullish candle confirmation appears. This is literally the higher low. The bullish confirmation candle appears because remember, we're looking at this entire pullback. I'm just focusing on this section right here so you guys can see the bullish confirmation candles. You
Well,
get it?
higher low compared to what?
Compared to this right here. This is the high. Yeah, this is actually, because this is break of structure. Let's go to the 15-minute. Where were we? This is a break of structure, right? Right here.
Yeah.
That means that this is the higher high, right?
Okay.
This is actually just the high. Over here, actually it's up here now, is the higher low that's formed, right? This is why it's even better to trade on the higher time frames. That's why I don't focus on 5 minutes unless I need to do some real detailed price action management. But since we started there, I'll go back to it. Does that clear that up for you? This right here is the high.
Mm-hmm.
And this.
And that's going to be the high. Oh, I got you.
Yeah, in the overall structure, because it's from all of this, right?
Right.
You wait for the bullish confirmation, and then you enter there. You enter there. When you enter there, you have the option to place your stop loss right under the last low, which is the wick. This is a combination of how to enter and the Fibonacci. You always want to use the last low as the stop loss, or you can use the stop loss that I actually send you guys in the setup, in the analysis that I have originally. You see how that goes, Carlos? You'll place your stop loss higher because now you're taking more risk. So you have to respect the last low that was created after your confirmation candle pattern printed. Is everybody clear on that?
Where did you put the stop loss higher?
So originally, this is the
original play.
This is
if
the
you
play.
missed it.
If
you missed it.
If you enter here, this turns from a 432 tick play to about 700. You don't want to do that. So you wait for the candle patterns, the bullish candle patterns, and you use the last low. You use the last low as yours because now this is your setup.
Mm-hmm.
This is your setup. So if it does come back, you want to make sure that you're under the last wick, not at the wick, but under the last wick. How far? That is subject to the trader. I tell people 10, 20 ticks away. You know, you want to let it breathe because sometimes price will come back and just want to do a liquidity sweep down here and then continue again.
Mm-hmm.
If you're going to trade like this. So don't put it like right under the tick just to save a couple dollars.
Mm-hmm.
Make the risk proper, set your play, and then let it rock. And you can take advantage of this continuing.
In this case, this candle bullish engulfing never came back to a 618. I would have missed this play if I would do what confirmation means. Now, the only other thought of it is if it doesn't in bullish candle, then you let it come retest the structure, which is above the candle, and then it should go move forward, which is what I think Kevin was asking about.
That's catching it up here.
No, I mean catching it where it taps.
You don't want to be up here.
No, I agree. It never came back for a 618 is what I'm trying to tell you. Even in a smaller time.
In this case, it never came back.
It never came back, which means you get left. So another way of getting in is the part that you were just explaining, which is create your risk management under that low. Let the bullish candle, which I think this is 5 minutes only. Once it confirms, which it means it retests above the candle of the bullish engulfing, it retested it and then it pushed off from there, right?
Well, when you're getting in here, you're not waiting necessarily for like a retest or anything like that. This is your entry because the 618 was already tapped and rejected. This doesn't even exist right now. The only thing you're looking at is the price action, the candlesticks. So you've already got your 618 rejection. The only thing that should allow you to want to enter is a bullish confirmation candle pattern.
Candle. You don't wait for it to come back, is what you're saying. You already know it wants to go up, so you buy at the top.
If it
and
comes
then you let
back,
it ride.
if it comes back, it comes back. Then you take the
Yeah,
L.
and that's your, and you take the L. Got it.
In this case, it worked out. It worked out, and you were able to grab a piece of the impulse, because now this is the impulse, this is the correction, and that is the continuation. You get it? That's what it is. You only set your stop loss after this is closed. After this candle is closed, that's where you go and set your, because you don't know where the low's at. This thing could come back here while it's open and create a lower low. You don't know. That's why you have to wait for it to close. And once it closes, you can decide to enter there and place your stops below the last low so that you don't have a super wide stop loss. It's a lot to take in. There's a lot of moving parts. But once you get into it, it'll start coming together and clicking. Because especially once we start doing like live setups, then everything starts making sense. Because I'm giving to you guys in pieces. Right? So, is everybody clear on that?
Yeah. Yes, sir.
Okay, perfect. All right, I need to look for a bearish setup.
When it did the pullback right there on the top of that play, when it did the pullback, can you see why it did the pullback? Yeah. Can we look to the left and see if it gives you a hint or why it pulled back right there?
Oh, no, it's right in front of you. Market structure.
I do have like one my apologies.
Say it again.
I do also have one question, but I didn't want to interrupt whoever was also still going.
That's all right.
So the reason why it did that is because it broke structure right there, and then it retraced, right?
What does price do? Every time it breaks structure, it has a tendency to do what?
To retrace, to confirm it.
At some point. Doesn't mean it will. It could have just kept going.
I just need to know when I should be taking profit at that point. You know what I mean?
You should consider market structure always points of taking profit. You should always consider that.
But in this case, wasn't the reason, or was it?
I mean,
it wasn't.
This is structured. Like, I'm telling you that you should always consider market structure as points of taking profit. Like, I would have told you guys to take profit right here at this thick line. I would have called it out. Like, we're up, whatever. We're up 330 ticks. Take profit if you like it. Take profit if you like it. I'm always calling it out. The reason I'm always calling it out is because I see things that price action is doing, whether it be exhaustion or reaching points of structure. That's why I call it out.
We did that today on gold.
We did that today on gold. That was a point of structure.
How do you find exhaustion? Volume or
exhaustion? You'll see that in the wicks. There's a wick lesson too, so you'll be able to go. You'll be able to go over that. It's recorded. The exhaustion is in the wicks.
Okay.
We'll go over that we can go over that after this. Tristan, what was your question?
So I definitely feel like you answered this probably in a session before or anything like that. But my question is, in terms of your higher time frame, placing the fibs and market structure, do you have specific time frames that you look for, or do you just go, oh, let me check the 1 hour, let me check the 2 hour? Do you go, do you go 30-minute, 15-minute, or do you have how would you do it, like top-down analysis wise?
Top-down analysis is what I start with every morning. I never look at lower time frames when I open charts. It may open at a lower time frame, but I'll immediately start at the daily.
Because I don't mean to interrupt again, but just because I know you said earlier, sometimes when you're looking on a lower time frame and you're placing the fib on that lower time frame market structure, sometimes it'll blow past that 618 fib to a higher time frame 618 fib. Yep. So I just want to get kind of like a clear.
That's the best way. It goes to what you're asking. Like, the best way to avoid those traps is top-down analysis. I can't stress that enough. My tap down analysis is very simple. It goes like this. It starts at the daily. From the daily, I get an overall direction of what the market might be wanting to do. Just because the daily says long or says bearish or bullish doesn't mean that that's what's actually happening on the lower time frame. But it will give you a clear indication of market sentiment when you start on the daily. If you open your chart and the daily is telling you long or short, you can start building a bias off of that. From the daily, I immediately go to the 4-hour and start looking for market structure confirmation of what the daily just told me. From the 4-hour, I go to the 30-minute and start looking for market confirmation or market structure confirmation of what the 4-hour was just telling me. If those three line up, I start looking for plays on the 1-hour, right? And I'll either place my fib, which is 90% of the time on the 1-hour, or the 15-minute. The time frame correlation goes like this. The daily correlates with the 4-hour. The 4-hour correlates with the 30-minute. The 1-hour correlates with the 15-minute. So it's a little switcheroo on the lower time frames, but that's how it goes. I'll say it again. The daily time frame correlates with the 4-hour time frame. The 4-hour time frame correlates with the 30-minute time frame, and the 1-hour time frame correlates with the 15-minute. Notice I didn't say anything lower than 15 minutes because I'm not looking for scalps. I'm looking for the movement of the day. And Tommy, what do we usually catch?
We catch the whole movement.
We catch the movement of the day. I'm not looking for 20 ticks when I'm in a play. I'm looking for hundreds of ticks. Sometimes it goes into thousands of ticks. That happens. Man, I can't count. I'm not patting myself on the back about it. I'm just giving you the truth because those are the time frame correlations I come from. I am a high time frame day trader and swing trader. So when I look for plays on the 1-hour and we're entering on the 5-minute, I'm sorry, the 15-minute, we're running that shit up. I want the pie. And even if I catch just a piece of the pie, I'm happy with that because those pieces of pies are big bags. They come filled with hundreds of ticks. So that's the time frame correlation that I use. Does that answer your question?
Yes, sir. I appreciate it.
Okay, cool. All right. So let's go for bearish setups. Bearish setups. Let me see, right? Oh, then she just froze on me. Okay. On the bearish setup, the market creates a low or lower low, right? You have to draw the fib high to low, meaning in this instance right here, right? And I can tell you just by eyeballing this is a 618 retracement, just by eyeballing it, right? You have to draw the fib from the high to the low for bearish setups, right? Price retraces into the 618. Price forms a lower high. You wait for the bearish confirmation candle, and then you enter short. So let's take a look at what that looks like, right? We see the high, we see the low. On a short, point A goes on the high or the swing high, whichever term you want to use, right? Let's play this back here. Actually, we could use this right here. We can use this because this is a great example. Oh, sorry.
Yeah.
Just like that. So we do 0.8 on the high, down to the swing low, right? And we wait for bearish confirmation candles. Now, what do you guys notice about this setup here? Whatever stands out to you. What do you guys notice about this?
Lower lows.
Well, where did price go? Where did price end up?
786.
786.
It came to the 786. Why do you guys think that it came to the 786 instead of stopping at the 618 in this case?
Structure.
This guy knows what he's doing. This guy knows what he's doing.
Show it to them because there you go.
This guy knows what he's doing. The price ended up coming back to the break of structure, which price, when it breaks structure, has a tendency to come back to retest structure before continuation. That is a market structure lesson, Kevin, for you. It's in the market structure class. This is very important. The only reason I know that I should start looking for shorts is because the market decided to break structure and close to the downside, right? This little indication right here signifies to me that the market may want to go short. Now, it could still do this and then continue up, or it could just go sideways as well. But in this case, the market decided to want to go short. Why do I always tell you guys to use market structure or the 786? Because sometimes I'll place a stop loss all the way up here, and some of the traders in the chat, they don't want their stop loss that wide. So I always recommend to them, place it behind the 786. Because sometimes, especially with indexes, they tend to want to test the 786. This is what you consider a deep retracement. Indexes have a tendency to do that at times, just so you know. Gold has a tendency to do that at times too. But what really stopped it is not because the 786 was there. This doesn't even exist in the market. It came to test market structure. It came back to retest market structure. That is the important factor that I want you guys to take away from this. This market structure right here would have gave me all of the confirmation to hold this, even in this drawdown. This would have gave me all the confirmation, all the conviction to hold this play, even in this drawdown. Because as you can see, the entry would have been here, which is where we always enter. But the market decided to create a deeper retracement and go towards the original break of structure that confirmed the downside move, which would have told us we should be looking for shorts, right? Impulse, correction, and we enter on continuation no matter what.
And when would you add to your position at that point, at the 618, when it did a bullish and
adding position? That's subjective to the trader. We'll get into that next.
Okay.
So the bearish setup, the market creates a lower low. We draw the fib from the high to the low. We wait for price to retrace to the 618. Price forms a lower high. In this case, this bullish engulfing candle pattern, right? Right, guys? Mm-hmm. I'm sorry, not bullish, bearish engulfing candle pattern. Bearish because we're looking for shorts. This confirms to us that the market may want to start to continue down. You always use may, possible, because why? You don't know shit. Nobody knows shit. The market's going to do what it wants to do. It could still do this. We could be in profit and it could still come back. You don't know. And that goes back to the risk management I was talking about before. Accept the fact that you may be floating in drawdown at times and you have the conviction to hold the play because market structure is telling you that the play is a high probability play. That's what makes good traders last in the game. That's what makes any trader last in the game, sticking to their guns no matter what. So in this case, this bearish engulfing pattern would have been the entry if you're waiting for confirmations to enter. You could enter here, right? You could enter right there. I'll make that wider. You could enter right there, right? You can either use the stop loss that I set, or you could decide where you want to place your stop loss within the stop loss area, right? The stop loss area means whatever this market structure is here. Anywhere within this market structure, you have to decide if you're going to, if you enter like this, you have to decide where you're going to place your stop loss. Some guys would place the stop loss here. Perfectly fine. That's a tight stop. These things happen and these things play out. Some guys would be midway. Some guys would just use the safety zone. Why is this the safest place to put your stop loss, guys?
Because that would be a break of structure at that point.
Correct. Making the play invalid, and you're wrong anyways, which you should be okay with, no matter what. So if you place your stops here, let's just use it for an example, just above there. Or if you place your stops here, it's just subjective to you as the trader. It just all depends on you, right? I give you the idea of what I'm looking at, and I'm using the market as a whole in order to create a high probability play. Whenever you modify what I sent you, you have to accept that you did it. You have to accept the fact that now you're in a tighter play, which means if you place your stop here, you're in the middle of the fire. There's nothing wrong with it either. That's not what I'm saying here. I'm just telling you that the tighter your stops are, the higher chance it is of you getting stopped out, unless you're a scalper, and that's a different type of trading. But I am a higher time frame trader, so I'm looking at the bigger moves, which consist of bigger moves and fluctuations in price action. They move at wider ranges, so you have to allow the trade to breathe in order to profit correctly. If you don't give the trades that I send you from higher time frames enough room to breathe, you have a higher chance of getting stopped out. Does that make sense, guys?
Yeah.
Yeah.
Okay, perfect. So again, there's nothing wrong with tight stops. There's nothing wrong with it, but you have to accept it. If you placed it, leave it alone. You have to accept it, right? So let's say we entered here. Now we're going to let the play rock. This is for bearish setups. Once you get the bearish candle confirmation, you can either enter short here or use the limit to enter short here. Right?
Now we are making, Jose, I know we're making the play in 5 minutes. I know you're doing this as an example, but is this normally what you would do on a 5-minute play?
No, I'm just using this as price action.
Example.
Don't even worry about that. This is a 5-minute chart because this happens on all time frames.
Yeah. But just for especially people that are just starting, you know, because I get confused looking at it. I'm like, but wait,
no, I'm just using this. I'm just using it because it's a great example of how to look properly. Now, you can, if you're really good at price action, you can use the 5-minute. It's not that the 5 minutes illegal, but if you're not really good at price action and reading market structure properly and understanding the fact that these are higher time frame analysis,
shorter time frame,
you can get clapped. A 5-minute will do you bad because a lot of the times when you're in the lower time frames, you forget that what I send you is coming from Big Mama. Big Mama needs to breathe. You get what I'm saying?
Yeah.
So if you do go down to the 5-minute, just make sure you know what you're doing. That's all I tell you. It's subject to the trader. It all depends on you. But this is just an example of what happens on all time frames. So there's an entry here. There's an entry here. This is the stop loss. This is the stop loss for this entry here. All different types of stop loss. So we got 1, 2, 3 stop losses, right? Let's see how the play works out so that you can see by example why I do what I do and why you as a trader, you're gonna have your own styles. That's why a lot of guys, some of the guys, even when I send them whatever my stop loss is, they place their own stops and they're winning too. But that's because my analysis is really tight. That's why. But it's dangerous. Just know that when you're inside of the risk that I've calculated, you're in the fire. I'm not in the fire. I'm back here chilling, sipping coffee, waiting to see if I'm right or wrong. I don't care to have a tight stop loss because I'm looking for a nice piece of the pie as far as the profit is concerned, right? So let's see how this plays out. And profit, it came right back. Stop loss 1 is hit. The tightest stop loss is hit on this particular play. Still retracing. Now it decided to go. You get what I'm saying? You see what happens when you place your stops too tight on the types of setups that I'm giving you? The reason is because I'm not sending you scalps. If I was sending you scalps, the type of setups would be adjusted to a scalper setup. I'm sending you day trades, and day trades need to breathe. Does everybody understand why I'm saying what I'm saying?
Yeah.
Because I can't be any more clear than that. The day trades that I send you are coming from higher time frames, which means I'm calculating on profiting off of the move of the day, not just this, not just this. I'm looking for the move of the day like this, like that. That's what I want. I want the whole pie. And even if I don't get the pie, a slice of the pie to here is great. You get what I'm saying? That's why it's so important to understand risk management and why the types of setups that I send you need room to breathe, because they won't always just hit entry like we did today. We hit entry and we were immediately in profit. That happens a lot because of the experience, yes, but I still have my stops at a respectable distance to respect the market and allow it to breathe. Being okay sitting in drawdown is going to get you more rewards than losses. I don't know why. I don't make the rules. I just realize that that's how the market works. It needs space to move. And if you have your stops too tight, again, I'm not talking about scalping. I'm talking about day trading. If your stops are too tight in day trading, you have more of a chance of getting tapped out, just like this. This got clapped right here on the first. That stop loss is too tight. It was too close to the action. I like being away from the action, allowing the trade to breathe in order to see if we can create a profitable trade in the end. Does that make sense to everybody? Everybody good on that? All right. So let's get this back to normal. Let me get this out of the way. So now we're going to talk about the golden zone. Anybody know what the golden zone is?
618.
The 618. I don't know why they call it the golden zone, but that is the Fibonacci retracement formula, and that is the nickname for the 618. The 618 retracement comes from the Fibonacci sequence and is commonly referred to as the golden ratio. I know plenty of you have heard of the golden ratio. So many institutions and algorithmic systems monitor this area, which is why reactions often occur. And so why do you guys think I picked the 618 as my choice of entry area? Because that's, what's that, Kevin?
I said because you trade and you like to trade gold.
The assets,
that
the
just happens
assets
to
you
be,
use
that
tend
just
to
happens to
reflect
be,
that.
you know what I mean, a comparison.
The
What'd you say,
assets
Carlos?
the assets you focus on tend to respect that area, so you stick to 618.
Yes, but why? It's literally what I just described.
It's called the golden zone.
The reason why is because that's the area where institutions tend to send the market for correction before continuation. Banks are sitting, that's where banks want to sit at to collect orders and continue orders. So why would I want to be at the 38.2 when there's a higher probability that the bank wants to send the retracement down further for a better premium discounted price and then continue into profits? That's why I don't pay attention to the 38.2. And none of the assets that I trade have the behavior of bouncing off of the 38.2 and continuing. They do at times, yeah, but more often than not, they tend to want to retrace down into the golden zone. All right. So that's where wholesale prices, I got a tongue tied right there. Wholesale prices in an uptrend and premium prices in a downtrend. So basically the best price possible to enter a position and gain the most profit from that position. Does that make sense? That's why I enter from there. I like steep retracements because that's the best price possible, whether long or short. That's where I want to be entering at. I don't want to enter. Let me see if I can get an example here. Well, I'll just use the fib. I'll just use the fib like this here. If I'm looking for longs and the market is coming down, I don't want to enter here for this retracement. I want a steeper discount down here for the continuation. This is the best price possible, right? Because I'm going to make more money in the position from down here versus down here. Now, you could enter there, and good luck if you do, because you have a higher probability to suffer a loss if you enter in this with the assets that I trade. I trade indexes and metals, and these are steep retracement assets. Why do I also trade them? Because they pay the most. Why would I waste my time on an asset that doesn't pay enough in the same move as an index pays me like triple or quadruple in the same time and move? So I focus on the higher paying assets for my returns. All right. So let's look at the entry formula. The entry formula for an A+ setup is market structure, Fibonacci, and candle confirmation. Once again, the A+ setup formula is market structure, Fibonacci, and candle confirmation that we just went over. If you're not comfortable using limits, candle confirmation is the last step. So it's market structure, Fibonacci, and candle confirmation. Not Fibonacci alone, not candle pattern alone, and not support and resistance alone. The highest probability trades occur when all three align. That's an important line there. The highest probability trades occur when all three align, and those three are market structure, Fibonacci, and candle confirmation. All right. So let's go into trade management, which we were basically going over that earlier because we always fall into it anyways. Trade management. Let's say we got into this. Where was that trade with a bullish engulfing? This is bullish engulfing right here. Boom. All right. Trade management, stop loss. For a bullish trade, your stop loss goes below the higher low. So where's the higher low here, guys? Your stop loss goes below the higher low. It's right in front of you. It's not this one, in case you were looking at it. It is this one. This one right here. Right? Your stop loss will go below the higher low.
Why would that be called a higher low?
Well, remember, we're in the lower time frame, so it's making it look confused. Let me go up here. There we go. Here we go. I'm just using this as an example. Oh, that doesn't even do it right. So let's go. All right, this is perfect. Let's say this was it right here. Right? Right there. So this is the swing low. Just using it as an example. I'm aware of this wick, but disregard that wick. This is where your stop loss would go if you entered on this bullish engulfing continuation pattern. What we were going over before, remember, guys? Mm-hmm. That's where we would enter, right? And for a bearish trade, let me look for an example for a bearish trade. This is an example for a bearish trade. Boom. This is your high. Boom. Place your stop above the last high for a bearish trade. So you enter here, your stops go here, and that's how you place your stop loss. All right? Your target one will be your previous structure point. Can anybody tell me what the previous structure point is right here? So that
would be where
we can figure out where the take profit would be?
It would be, look to your left, and it would be that yellow candle, that structure.
This one?
No, above it. Above
this
it.
One? This
above
one?
It, right there. Yeah.
So that's one right there. That's one right there, right?
The second one would be below it, the order block.
That's too close to that last one.
No, all the way. You got to keep going.
Oh, down here. Yeah, down here.
Yeah.
You could pick here, this low, or you could
order
pick
block.
You could pick this here, this body of the bottom of the body.
Mm-hmm.
And this is essentially a 1 to 3.
Which is where, if you look at the play, it retraced from there.
Right. Why did it do that? Because it found support again at previous structure. This is why I always stress to you guys, trade structure to structure. Trade structure to structure. You don't need to be worried about if it's going to keep going. Forget about all of this. You just did a 1 to 3 right here. All of my trades are always 1 to 3. All of them.
Yeah,
if I send a trade that's like a 1 to 4, 1 to 5, that's because market structure said it's available. And so I send the play like that. But 90% of the time, the plays that I send you are always 1 to 3s. Every time. They're based off of market structure, and they're also based off of the Fibonacci. All right?
And key levels.
Target 2, that'll be target. This is target 1. Like, let's say we didn't have TP 1, 2, and 3. We were just going from structure to structure. This is TP 1, right? That'll be TP1. Or you could use it like this. Like how you were saying before, that's a good one right there, right? Anywhere around here, actually this would be, because you can use this long positioning tool to determine what a one-to-one is. This right here would be one-to-one. Because why? We determine what our risk is, and our risk is about 300 ticks, right? So what you do is you take the positioning tool and you measure out what the risk to reward ratio is going to be at one-to-one, and you set take profit one there. After you set that, then you move your positioning tool down to 1-to-2, which is right here. This is take profit 2, which is where, Carlos? Right there where you said with that market structure. Boom. 1-to-3 is all the way down here. Boom. A perfect 1-to-3 trade. Trading like this. Setting your, finding out your analysis, figuring out the bias, waiting for bearish confirmation candles, bearish engulfing candles to confirm that there is a short in play. Entering, setting your stops, and figuring out your take profit 1, 2, and 3. You could be a 50% trader. You could have the win rate of a 50% and still be an extremely profitable trader. When you trade like this, just focusing on 1-to-2s, 1-to-3s. You know how I know that? Because I do it all year long. That's how I know that. I don't need 1-to-10s. I don't need them in my life. 1-to-10s would mean that now I'm swing trading because I'm a higher time frame trader. Now, can I turn this into a scalp? Of course I can. That's the beauty of the setups that I send you in the premium chat. Every single setup that I send you, let's say you're a scalper. We have a scalper now that just joined us again, Semi. Semi is an assassin when it comes to scalping. She is an actual scalper. She doesn't take my trades as day trades. I coached her into using my day trades as the directional bias for that session. And what do you think she does with that information? She uses scalping in order to scalp all this shit in that one direction that I sent her. So if I sent a long play, she'll only be looking for longs, for scalps. 10 ticks here, 20 ticks there, 30 ticks here, 50 ticks here, pep, 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 pep. The entire time the play is playing out versus just holding it. That's the really cool part about what it is that I do. You can use it in any which way form that you like. You just have to be really good at market structure and price action. You guys get that? So if you are a scalper, you can use the setups that I send you guys and scalp the market into profits. All right. So like I said, I prefer 1-to-3s. That's what these setups provide on a weekly basis. On a weekly basis. And I'll only send 1-to-2 setups max per day because that's literally all you need. You got guys in here making bands. Some of them make even more than I do on certain trades because they trade more aggressively than I'm a conservative trader. Sometimes I'll stack and I'll get real aggressive, but it's due to my account balance. I can do it. You know, so if you don't have the account balance, be conservative. If you've got a large account balance and you're feeling confident that day, see what you feel like once you up your risk, stack your trades, and take it from there. And just make sure that you're using proper risk management so you don't blow your accounts. So I've got some simple rules, very simple rules for a very simple strategy. I only buy when market structure is bullish, when price retraces into the 618 zone, when higher lows form. What is a higher low? It is the correction before the continuation. And I'm talking about buys or bullish confirmation candles appear. I'll say it again. I only buy when market structure is bullish, price retraces into the 618 zone, higher low forms, and bullish confirmation candles appear. Everybody clear on that? I'll send you guys the list anyways. This is a checklist. I only sell when market structure is bearish, the overall higher time frame market structure. Remember, top-down analysis. I'm coming from the highest time frame down to the 15-minute. So whatever that tells me, if market structure is bearish, I'm only selling. When price gets into the 618, that's the only area that I'm looking to short. When the lower high forms, which is the correction from the impulse, the lower high forms and bearish confirmation candles appear if I'm not using a limit. I'll say that again. I only sell when market structure is bearish, price retraces into the 618, lower high forms, and bearish confirmation candles appear. Everybody clear on that? They're very simple rules, but you need to stick those in your head, and I'll send you guys the list as well. So you can write it down if you want, but I'm going to send you guys the entire breakdown of that. So we're going to go into the golden rule. The golden rule is, which a lot of traders do this, the golden rule is never use Fibonacci to predict direction. Why do you guys think that's important? You never use the Fibonacci to predict direction. Why is that important? Why do you guys think? Any answer? Why do you guys think that I never use the Fibonacci to predict direction?
Because you're supposed to be using it to gauge where to get in and out at, but the direction should already be determined.
Correct. By what? What is the direction determined by? We just went over it.
Market structure.
Market structure, the overall
market structure. Direction is formed. Bias is formed. The idea is formed from market structure. Never use the Fibonacci to determine market structure. You will get clapped. You will quit trading if you think that the Fibonacci is a magical tool that will tell you the direction of your market. You are fooling yourself. All right? You use market structure to determine direction. You are correct, guys. That's what you use. After you use market structure to determine direction, then use Fibonacci to find a discounted entry within that direction. Within that direction. You use the Fibonacci to find a discounted entry within that direction. Within the direction. Never to determine what the direction is. So structure tells you where the market wants to go. Fibonacci tells you where to join the move. That's very important to understand. Market structure tells you where the market wants to go. Fibonacci tells you where to join the move. Where to join the move. Market structure is already telling you where it wanted to go. This is where you join the move. Market structure is already telling you where it wants to go. This is where you join the move. It's very simple once I break it down like that. I know it's different once the markets are active and your brain cells are firing this and that third, but that's what ultra pouches are for. So place your order. This is how professional traders use the Fibonacci, not as a magic indicator. The Fibonacci is not an indicator at all. It is simply a tool that you use to find entry areas. That's all it's for. It's not an indicator at all. A lot of people confuse it with being an indicator, but it is not. You use it for precision and a precise tool for entering trends at favorable prices. Entering trends at favorable prices. Entering trends at favorable prices. Not up here. All right? Not up here. We don't enter like that. We don't buy at highs. We buy at lows and we sell at highs. We buy at lows and we sell at highs. That's how you become professional and proficient in trading. All right. So that's the end of the Fibonacci lesson. Now we can get into questions. What you want me to go back into. If you want me to show examples, you guys let me know.
I think something you just said that made a lot of sense, and it just makes it as simple as possible. It's just no matter what, you just never buy when it's creating a new high. Like it's just not something you do because now you're gambling, predicting that hey, since it's going high, it's gonna go higher, and that's not how the market works. So
you can, but just you're gonna experience something that you're not gonna want to experience. It's not gonna be pleasurable. You know, sometimes you get lucky and the market is just ripping. You know, sometimes you get lucky and you enter and it's just ripping, ripping, ripping. But you know where you fucked up? You don't know where to exit. So you don't know how long it's gonna rip. And while it's ripping, it could rip back. As strong as it went up, it can come right back down. So if you don't have a trade planned out, what are you gonna trade? Now you're just gambling. Really, that's gambling and trading. I'd rather plan my trade and trade my plan.
Do something like this. This will just give you an example. What do you do, especially with your experience? Go into the ticker symbol and put SanDisk. And I just want you to see that for a second.
SanDisk?
You tell me what. Yeah, SanDisk.
That's a stock, right?
Yeah, because I just want you to tell me what do you do when you see things like this and you're just like, I'm not going to get in because it's just pumping. I need to wait till it retraces, but it never does. So look.
What's the ticker?
Just put SanDisk. They'll spell it out. SAND. Yeah, it should come up. SDK or something like that. SanDisk. Yeah.
All right, so SNDK. All right. So what would I do here?
Well, go to the higher time frame so you can see.
That's the first thing I'm going to do.
Yeah.
All right. So we're looking at SanDisk right now. All right. So what is your question?
So I started hearing about this stock at like 600, but I had a bias.
I heard about this the other day too. So
yeah, who the fuck like works with SanDisk? SanDisk was the floppy disk back in the days. We don't even use that.
I mean, they do USB drives. They do these chips here. I believe they work on these too, but I know they do USB drives too.
I wasn't sure. I just had that biased opinion, so I was like, I heard about it like at 500-600, and it was already skyrocketing.
Yeah,
but this thing hasn't stopped. So analyze this because I want to know because I'm getting a lot of stocks that have like how can I say popularity, and then I find myself just looking at them instead of waiting for a retracement or jumping in.
Well, a rule of thumb, whenever you start hearing a lot about any particular asset, means that you're already too late. A rule of thumb. Okay. Anytime you start hearing a bunch of things on Instagram, oh my God, this one's popping, this, that means you already missed the move. So if you already missed the move, we just went over this too. What should you wait for? If you already missed the impulse, what's the next?
A retracement. A retracement.
You're waiting for the correction. You're waiting for the correction.
Look at this and tell me where would you have seen a correction here?
So
just as an example.
We got a correction here on this stock, right?
But how would you have found that? Because you're looking at higher time frames. I'm assuming what is this, daily? Yeah, this is the daily.
This is top-down analysis. I'm going to show you top-down analysis right now.
Okay.
So perfect. I don't need to look at any of this right here.
Okay.
Number one for time, and number two, this is where the action is at.
Correct.
Right? My eye immediately goes to this low right here, this higher low right here that formed.
Okay.
Right? This is the higher high, and I'll map it out. This is the higher high. This is the higher low. And we've created a new high. All right? Why is this the new high? Obviously, it's high, but why is this the new high?
It broke structure, which should be
Broke
where you would
structure.
enter.
Yeah, you're going to walk through it with me. I'm going to walk you through it so you can see.
Yeah, I'm seeing it as you're doing it. I'm like, yo, it doesn't look
He's like,
like
hey, if he does it too fast, damn
that. No, I see it. As soon as
my eyes are trained for it.
Yeah.
So it's like my eyes are magnetized to market structure. It's just like bing, just laser point. So we've got our high, we got a higher low, and we got our higher high forming right now. And in the daily, we've got what? Right now, the market is closed, so this is considered a closed candle. This is a bearish candle. It is, you can't really call this bearish engulfing because it opened here, but it closed here. You know, let me make it bigger so everybody can see. That's a little bit too small, right? This is bearish, yes. The market closed bearish. So this could be the beginning of the new higher high, right? So because the market is closed right now, on the daily, we can see that the low is here. So let me mark that out. We can see that the swing low is down here. And the swing high is up here, right? Very simple. So I see that the market structure, the break of structure is right here. So I mark that out. Boom. That's fine. I'm eyeballing this right here too. Why do you think I'm looking at this point right here?
That's
I want you to think like a trader. Why would I consider this low in the overall analysis that I'm looking at?
Because that would be where you put a stop limit based on breaking structure at that point.
It's not about stops.
Okay.
It's about the fact that this was the last low created before market structure was broken. Right?
Okay. Got it.
So this is important to highlight. That's what. We're not getting into stops or anything like that. We're just doing analysis right now. So the first thing I'm going to do is after I've identified my high, higher low, and higher high, I'll pull out my fib and I'll start working it around the market structure. What is this called, guys?
A leg.
This is a leg, yeah. But what did we go over today? What's the other name for it?
Impulse.
Correct. This is the impulse up. All right. So we're going to go from point A, which is we start low when we're looking for a bullish situation, which this is. We'll go from point A. We're going to go to point B, right? And we're just going to leave that there. The reason why I want to mark that out is because I want to see what the overall extension could be of the overall move for SanDisk. Granted, this is a stock. So you're looking for a position to enter for an investment. And we'll also be looking for a position to enter as a day trade as well within the days, you know, because every single one of these candles is a daily candle. It took an entire day for this candle to form, open, and close. Okay. So I just want to mark that out. I want to see that that is the 618, right? And I want to label that. I'm just going to get this out of the way. I've got an area of interest on the daily. You've also got a bearish candle there, basically like an order block, you know, and I'm just going to label that out. I'm just walking you through what I would do when I'm looking at the stock that you're looking at, right? From the daily, what's the correlating time frame from the daily, guys?
4 hours.
4 hour. Let's go look at what the 4-hour market structure looks like. All right. This is 4-hour market structure. All right. You got the break of structure here. Let me relabel this as daily. Everything you do on specific time frames, you label for that specific time frame, so that when you're on the lower time frames, you know what you're looking at and what the strength of it is, where it came from. So if it's a higher time frame identification, you label it as such. Just like this 618 down here. Hold on 1 second. This is the daily 618. So we know that that's the daily 618 when we just look at it. It just helps you, it helps your workflow that much better. All right. So we've got on the 4-hour time frame, we've got break of structure. All right, this is the 4-hour break of structure. We've got a 4-hour break of structure. A 4-hour break of structure. All right. You just want to label that out. And so what you're looking for, Carlos, is where you should enter. Right?
Mm-hmm.
You're looking for what you should do with this stock, basically, right? Like, what am I gonna do here? It's already at the highs.
Yeah.
Yeah, this is an
I'm
all-time highs.
getting plays like that over and over, and I'm just looking at them. Like I said, I saw this at 600, and it's 1800 right now. So imagine.
You saw it at 600.
Remember seeing this at 600? I think like less than a year ago, or this year. I don't remember.
That'll make you feel crunchy.
Mm-hmm.
All right, so remember we saw this as an interesting low, right? On the daily. This was the last low formed before the break of structure to the upside on the daily chart. So what you could do is you can start analyzing like this too. Like I already see something that I like, but I just want to see if it lines up. So this is the low. This is the high. Point A, point B. Let's make this smaller. Point A, point B. Right? Now, let's zoom this in right quick. And let's make this thicker. Okay. Let's see what we're looking at here. First thing I want to do also with the fib is see what does this thing like. Because I could be coming looking for a 618, but I don't know what it likes. So let's see what this leg was doing. This is a low. All right, so this is a 38.2 retracement. This is what it's showing me at the start of this leg, right? We got 138.2. We'll move that point B up, and point A moves to the last one. We've got another 38.2, right? We move that leg up. We go up here. We go up here. We go up here. And we have one 618 retracement. It gave us a deep one right there, right?
Happens to be where the structure is as well.
Yeah. So let's
behind
move
it
that
to your
up.
left.
Let's move this up. We've got another 38.2. So this has the behavior of shallow retracements. It doesn't give steep retracements. It gives shallow retracements. So this time it's cracking down. It did give a rejection at the 38.2, but now it's coming down. What do we have here? We've got a 4-hour order block. Let's extend that. That's a 4-hour order block. All right, we want to make sure we label that. This looks interesting. Let's look at What's the correlating time frame after 4 hour?
30 minutes.
30 minutes. Let's see what if the 30-minute gives us something to look at. Now this is going to be more data, so the price action is going to be different. All right. All right. This is interesting. I see that it came in and filled this gap, creating this. When I see this here, I want to see what it looks like on the 1 hour time frame. I don't just jump around time frames just because I just want to see. It's for correlating reasons, right? So on the 1 hour time frame, you can see that we've created a new low here. So this is when you get flexible in your analysis. You don't remain stiff. You read the price action and you start moving things around to see if you can make the price action make sense. So we move this here, right? And then we go back down from here. I want to see it back on the 30-minute. All right. Let me see the 15-minute. This is just on the market's closed too, so we're not going to see. So we're looking at this here. This is breaking down from the 38.2. We've got a 618 there. It's rejecting the area already. This has been for, what day is this? Today is the 2nd. So since 9:30 this morning, it's found support here, but it broke below and this candle closed. So this is telling me that the market, when it opens, may want to open lower. We don't know that until the market opens, but when it opens, it may be in two different formations. It may be that the market opens and wants to retrace from this market structure and then continue down into here or even further, right? Or it'll open and then want to continue back up, respecting this as foundation, right? Right now, we're just following the clues to see what can we do with this thing, right? That's all we're doing. So we're thinking. There are no decisions being made yet. So I'm going to go back to the higher time frame, which simplifies reading the market. It's just going to simplify it for you. So this is definitely in the bullish trend. It didn't respect the 38.2 here. It broke structure to the downside, came back and retested the structure and is still moving down, right? This is the first indication, if I'm correct, out of all of these retracements and moves, right? This is indicating to me that the market may want to start moving down. You understand why I'm saying that? This is the first indication that's starting to tell me that the market may want to move down. Now, will it when the market opens? We don't know. The only thing we can do here is wait for the market to open and see if it's going to respect this as support and then start moving back up again. Let's see the 4 hour. Move this back here. What is this low here? Oh, we got a low here. Oh, Now the fib is making sense. You see what happened there, Carlos?
What happened? I can't see yet.
So remember the fib was here.
Mm-hmm.
Nothing that I saw here made sense. Like I didn't really like the market structure that I was seeing. All of this has already been respected. This could just be going here and using this as support, maybe dip down again and then continue. But then I said, let me see what happens if I move point A to the lowest low before all of this happened. Because this right here was the first break of structure right here, right?
Mm-hmm.
As you can see, this is the first break of structure. Let me make it bigger. So then I said, okay, let me see what happens if I move point A to the last low before the break of structure. And look what we got. What do you see here? Where is the 618 sitting? When market breaks structure, when the market breaks structure, it tends to do what?
Come back to retrace. So it wants to come back to the 618 and market structure.
It's possible that this market may want to retrace down into this area here, which is the break of structure. This is a very interesting area of interest right here. It's possible that the market may want to come back all the way down to the 1600 level, which is a psychological level because it's a round number, and then continue from there. This is possible right here. This is what you could be looking at. Now, let me see what the weekly looks like really quick. Yeah, gapped up. This was the last week. This is this week. This week still has 2 days and 17 hours to form this candle. This candle is still forming. Even though the market's closed, this candle is still forming, right? Right now, it's forming a doji. What do dojis at the top of runs signify?
Change of direction.
Possible change of direction. It's all about what the next candle does. And that's in a week. And that candle could very well take the market back to the break of structure, which is also, what is this? Big ass weekly candle also? What do you think this is? That's a big ass weekly order block. Very, very, very strong indication. So we label that, right? Boom. Top of the weekly order block is right here. This is giving me confidence. This is giving me confidence. So this could very well be the entry level right here. 1600 area could very well be. And also what's sitting there? A daily order block. This thing is just giving the clues away. Like this shit just giving the play away. Baby, I don't know what to tell you. It's just you see how it just starts to come together the more that you read it, and the clues will start just popping out as you do your analysis. So now we've got a daily order block sitting on top of the weekly order block, which is also following the break of structure on the higher time frame, the daily. The point A on the last low before the continuation, and this is where the 618 sits beautifully. Price could very well want to come back and retest this. That's the possibility that you're looking at. That's the possibility. Because if not, it's just going to respect this order block here, this situation here, and the 38.2, which it has a tendency that we saw, it has a tendency to respect this particular asset. It could just come here and continue. So you're looking at two possible destinations or areas of interest, rather, that could happen. That's my analysis.
So do you wait for a candle the next day, or like you trust your analysis and you decide whether you want to place the trade at 38.2 or 618?
Well, these are stocks. So like if I was looking to invest, right?
Or day trade.
Or day trade, even day trade, I would be
Okay.
waiting for candle confirmations to confirm to me that it wants to continue to the upside. So I would look for bullish engulfing confirmation candles, like we went over earlier. That's what I would be looking for.
You're not doing anything until you see that bullish engulfing candle.
For this particular stocks, I would wait for that, which is the way to do it properly when it comes to this. You want to wait for it to tell you.
Because the indexes you don't.
Well, with indexes and trading, I've got that on lock. I've never traded SanDisk. So for me, I would revert back to the original steps. And the final step would be waiting, in this case for long, if I wanted to go long, waiting for bullish confirmation candles or engulfing patterns that it wants to continue back to the upside in either this area or this area. That's what I would be looking for. Just like that. And I got, it could possibly go here. Remember, all of the plays, any analysis that you make is always 50-50. That's something that you have to accept in trading. You don't know what's going to happen. All you can do is your best analysis and wait for the proper indications or signals that it is going to work out or have a high probability of working out. So in this case, because it's a stock, it's SanDisk, you also have to take in the other factors. I don't know, earnings reports, mergers. These guys said something wrong, all types of shit. That's why I don't trade stocks by themselves. I trade indexes, the overall price action of a number of stocks put together, which actually move those particular markets. When it comes to this, you have to be a lot more detail oriented. And if you thought you needed to be patient day trading, you definitely need to be patient with this, especially if you're not trading, you're investing, then you want to wait for bullish confirmation candles. And I'd wait for those on the 1 hour, the latest. The earliest. I wouldn't even go down to the 30 or 15-minute for these. But you can see, like if it breaks down here and it rejects and goes up, it would make sense. Why? Because this was the previous break of structure. If it does go down here and move up, it would make sense. Why? Because this is a previous break of structure, and this order block was never the price never returned to this order block. So there's a high probability that price may want to continue back here to pick up some liquidity. So this is what you're looking at, Carlos, for SanDisk. These are your possibilities if the trend continues. Now, also, so you know, there is a third situation, right? The third situation is going to be that price wants to go here to the daily 618 and then continue. That is also the third situation that you're looking at for SanDisk. Just so you know. I think this one will happen. This one could get broken. It could get respected. Because again, this thing is bullish, man. This thing, it hasn't shown anything like this yet. But it's starting to form up here on the, I believe it was the 1 hour. Yeah, the 1 hour. We got a high.
Do you ever look at
Lower
like
high,
the
lower low,
gap?
lower high. What was that?
You ever look at like the gapping? It's like, oh, well, this much time has passed and it just looks like it's due to come back, just the pace based
It does.
upon, the gap,
It does. And on this, like because this is why you have to be so detail oriented when it comes to day trading or price action, period. When you're analyzing a stock, we had a high, we had a lower high. I'm sorry, we had a low, we had a high, we had a low, we had a lower high, we had a lower low, we had a lower high, and right now we're waiting to see what this is about to do when it opens. So what do lower highs and lower lows signify? Anybody? That there is a bearish indication. It could be wanting to switch around. Mind you, this is the 1 hour. I'm not in 30-minute or 15-minute. I'm not looking at that. It could be that this is the start of the retracement, either to here, here, or here. Because this was the last large retracement that it had. So let's see how far that went. This thing did 311 points. What is that? Points? Oh, 347. 301. I gotta figure out how they calculate those. Oh, that's not by mistake. That is not a coincidence, sir. I just did that live, measuring what the last retracement was, and what the next retracement can possibly be. Possibly. I just took the measurement from the last retracement here, right? And just put it here. And we already had this analysis on what could go where. And where did it end up? On the daily retracement. So those are your three situations that you're looking at, Carlos. So you know.
Yeah, like I said, it wasn't more of like where to enter. It was more of like, how do I see things, like especially with something that gets so, I guess it gets publicly, people start mentioning it, right? Like you said,
Yeah.
if I would have
There is
thought, like
that,
you
like
mentioned,
hype.
it's already too late.
Hype
Like I
create.
missed this at 600 because I thought it was already too late. It was like it already pulled. I mean, I already did the impulse, but this has been impulsing for a year. So it's like, how do you catch those?
Well, I just showed you. I just showed you how to jump in. You don't jump in. You don't jump in on the hype, because that just means that you're already too late. Once you start hearing buzz going around for a particular stock, that means you're late. That doesn't mean that you can't hitch a ride on the train. That just means that now you know that this thing is running and you need to find an area to enter. The way to find that is the way that I just showed you. That's how you find that.
Makes sense.
That's how you find that. You don't have to overthink it. It doesn't get more complicated than what I just did. Even though that might have seemed sophisticated, what you just saw was me putting everything together as a whole and using the fib together to find the proper entry areas. In this case, you have 3, because this particular stock behaves in such a way where it conducts shallow retracements to the 38.2. I only saw 1 retracement to the 618. Only 1 on this leg right here. You get what I mean? So I'll send you this so you can have it, and then make your own analysis. Make your own analysis. I appreciate it. You can see.
Hopefully that helped others too. So I see this happening a lot to me,
Yeah. Stocks are tricky, because like I said before, there's a lot of other things in play when it comes to stocks, man. You can't just do technical analysis when it comes to stocks, and that's the truth, because this is This is a working company, a publicly traded company. News really affects these guys, whether it's good or bad. Something happens with the CEO and you weren't up on the news and you went long and didn't even realize it, you could be losing. This is the main reason why I don't trade stocks in particular, because I have to also process extra pieces of information that I'd rather not deal with. So I trade metals and indexes because they're all this company is in what? In the NASDAQ? I specialize in the NASDAQ. I don't have to worry about what this company's problems are as an individual company, because that one alone does not move the entire NASDAQ. I trade the NASDAQ as a whole. So I avoid having to process extra pieces of information. I'd rather keep things simple. Can I trade stocks? Obviously I can. I can trade stocks. I just choose to stay in the markets that simplify things for me. The less decisions that you have to make in any analysis, the better off you are. Got it?
And I think it's also like two different types of trading. Like the trading that,
Yes.
you heard about SanDisk and why their stock is pumping because they came out with this new technology. It's completely different than day trading and reading the charts. If you wanted to buy and hold this from 600 till now, yeah, that would have been nice, but you could have got in at any of these points from just reading the charts and just day traded it and got in and out.
That's a good point. So let's look at it from 600. Let's see where we could have gone in at from 600 and see if there was even an entry at 600 for us to get in at.
Just below it.
So let's see. So the 600 zone was right here at this entry block, right? Oh, not this entry block, at this market structure.
It never came back. That's my point. There's no retracement.
There was retracements.
The shit.
There was retracement. There was a retracement in the 600 zone. Right here. And what do you see here? Let's mark off 600, right? Let's mark off 600. I'm doing this so you get in the habit of how to think and just remain flexible, because the market always provides an opportunity. It's just all about timing and being at your desk at the proper time to see if you can take advantage of the market. So we've got market structure right here in the 600 area right here. It broke down, came back up, and did what? Broke structure right there. Clear as day, right? So this is market structure. What do we do next? After we've read the structure, what's the second step? Pull out the fib. You're right, Kevin. You pull out the fib. We go to our swing low. We go to our swing high. And what is this thing respecting? The 38.2. This is a 38-2er. Not only that, all it did was come back to respect the market structure. It broke structure, and when market structure breaks structure, it tends to do what? Retest market structure, retest the break of structure before continuing. You could have gone in, I mean, obviously, if you're looking at it and you knew what you were doing, you could have gone in at 650 or 651 rather. Right here. Boom. I don't know if you play stop losses when you trade these things, but that's where you would have placed the stop loss. That's where you would have got out at, because this is what you call the invalidation level. If the market would have came back down here, all the way down here and closed below here, this is when you exit with whatever loss it is. You just exit because you don't want to experience the rest of the market bleeding. When candles come back down here and create a new low, you do not want to experience the rest of it. So just exit your position. It is what it is, you know, and then just wait. But instead, it broke structure, came back and retested, and continued. Now, let's say you missed 650. Then you use the, wrong one. You use the last low. You go back up here and you look for what? The 38.2. Why does it keep happening, guys? Why is it so important? Entry here, stop loss just below there. If you're using a stop loss while you trade these, and you ride that sucker up, that's it. This was your holding position. All of this right here. If you knew what to look for at them, I don't know if you were looking at it like that, like if it was something interesting, but that's how you would have done it. That's how simple it really is once you know what you're doing. If I was looking at this stock, that's what I would have entered. I would have just held my stocks, however many shares I had. And then it ran all the way 8,979 points. This is a this is a risk to reward of 14. Yeah. But this is stock, so you wouldn't even really look at it like that, but basically, you know, this is what you would have gotten if you would have gotten there. Obviously, this is in hindsight, you know what I mean? But now you have a new opportunity in front of you. You don't know how high it's going to go. You don't know how low it's going to go, but you have an analysis in front of you that you can go to, use it as a guideline, and wait for the right price confirmations to tell you when you should be entering. And that's it. You don't get any more complicated than that. Don't do any overthinking, no overanalysis, none of that. That's how you can take advantage of plays like this. Literally how you do it. Any questions about that, guys?
Could you just add leverage and just keep day trading, taking your profits all the way like up and just keep doing it every day?
Yeah, or you just swing it and hold it. You've been holding it because the thing is, you don't know how long it's going to go. You don't know how far it's going to go. In order to trade something like this, all the way up like this, what do you guys think I would be looking for to tell me to keep holding? What is the main thing that I would be looking for to tell me to keep holding in order to be able to hold all of this shit?
Higher highs and higher lows.
Higher highs and higher lows. And what? Breaks of structure. Breaks of structure to the upside. There's so many breaks of structures. This is break of structure here, 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 here. This started coming back down. This would have scared you a bit. You'd have been like, oh shit, maybe I should sell. Or if you have the patience, you hold, you hold, you hold. Break of structure, break of structure. All of this is just holding. All of this is just holding. This,
I'm getting out right.
This would have definitely, you know, this would have definitely made you sell.
Yeah.
But that takes experience, man. You don't know it's gonna go this high, man. Nobody knows that shit. Nobody knows that shit. The only thing that's gonna give you the opportunity to hold like that, like some King Kong shit, goes back to the basics. Market structure. You're reading the market structure. If holding a long position consists of the market creating higher highs and higher lows, the only thing that you need to look for are higher highs and higher lows. You don't need the fib or anything like that. Market structure is going to tell it to you. Now, for exiting, you need to start looking for the market to start producing lower highs and lower lows, because that's bearish indication and the market may want to turn around. That's why I said you could have exited here or you could have exited here. Either way, it's a banger. And the market structure and proper reading of that market structure would have allowed you to experience all of this from down here. Now you're in a new leg of bullish sentiment. So take what I just went over and apply it to that. I sent the analysis in the chat, but also go give it a go yourself and then compare your analysis and see if you can find something that makes sense for you to enter in. But again, do your research on the stock also. See what it is that they're doing. They got something coming up. Are their earnings good? Shit like that. So you have to look into that. But that's pretty much it. That's a good session. Anybody have any questions on the Fibonacci lesson?
No.
Everybody good? All right, perfect, man. Shit.
No.
We're good. You good, Kevin?
Yeah.
All right, perfect, man.
Better now.
Yeah, it'll start coming together. Once you get to price action and market structure lessons, the fib starts making more sense. Fibonacci doesn't make sense completely right now because you still have to learn the market structure. Fibonacci is second, like I said earlier in the lesson. Fibonacci is second to market structure. It is useless unless you understand market structure first.
What does an order block signify? So I get it, it's like two candles that are the same size, but one is like a bear. Like
well, this is an order block here. This is an order block. Well, let me go back to over here because you'll see it better over here. An order block is like areas. They call it an order block, but it's an area of liquidity where liquidity is sitting. And the thing about order blocks is the properly placed ones. Well, the properly identified ones are the ones that the market tends to go back to. It's not a determining factor on whether or not you're going to take a trade or not. Market structure is. Order blocks are built into the market structure. Like you've got, this is an order block. This is an order block here. Up here, this is an order block. I'll send you a diagram of all the different ones, but it's basically where liquidity is sitting. There's a bunch of orders sitting in there. There's different definitions for them, but I'm just making it really simple for you. This is where you can think of order blocks like magnets. Not all of them are the ones that I get respected, but as a matter of fact, the next lesson I'll turn it into an order block lesson, and we can go over that in detail. And that'll be crucial for you to learn, but it's irrelevant in the overall aspect of learning market structure. You get what I mean? Because you're not gonna see an order block at every play. When you do see one at your analysis and at your area of interest, you know what I'm saying? Load up. There's about to be some fireworks, and you're about to have a high probability trade when you do see one at your entry area that you've analyzed.
Well, what does it look like exactly?
Oh, they look like these right here. This is an order block right here. Let me make it bigger. These are advanced order blocks, but this is an order block right here. This is a bullish order block. Whenever you see a bullish, bearish, bullish sandwich, I'll call it a sandwich, the one that's in the middle, and as long as it's bearish, this is the bullish order block. I know it sounds confusing, but that's how it works. I'll use a bigger one over here.
So I'm looking at three candles. Three candles make up a order block?
Three candles make up this order block right here. I'm just showing you this one right here. So this bullish order block consists of this bullish, bearish, and bullish candle. The one in the middle is the one that you focus on. Now, if you look to the right, you'll see how many times that order block was respected. You got 1, 2, 3, 4, 5, 6, 7, 8. This one got ran. That's 9, 10 before it was finally ran through. So they do act as support or resistance depending where they're at, but you don't want to look at them like that. You want to look at them as areas where price is coming back to pick up orders, pick up liquidity before continuing to the upside. Sometimes it'll bounce right off the order block. Sometimes it'll run right through the order block and then continue. But we'll cover all of that in the lesson. So I'll make that a lesson in itself, because it does get, just like everything else, is detail oriented, and there's so many different variations of them that that'll take up an entire another lesson, and we don't got time for that right now. But yeah, man, we're good. Everybody good? Everybody clear on the Fibonacci? I think I did a good job on that. I don't know. You guys tell me, because I think that was pretty clear, pretty simple. And you guys can play this lesson back because it is going to be recorded, and I'll post it on the YouTube channel. I'll send the link out to you guys so you guys can review.
I appreciate your time. Thank you.
Yeah, for sure. We ran to 11:30. Not bad. Worth the time though, because I'm telling you right now, you get this down, you can become profitable. But the Fibonacci is useless until you get market structure down and price action. When I say price action, Kevin, I'm talking about the candles. What are they forming? Are they strong candles? Are they weak candles? Are they strong impulses like this? All of that is telling you a story. Those are the clues that you have to read as the detective in the market to look for your entries. All right? All right, guys. I'm signing out. I'll see you guys tomorrow in the morning in the premium chat, because there's some setups I'm waiting for, and they might pop off tomorrow. So I'll send them in the morning.
Awesome. Thank you.
All right, guys. Take it easy.